anytime you see rising economic and geopolitical uncertainty, that is bad for markets.
Are we going to see spillover effects in the Middle East? Are other countries going to get pulled into this? And you've seen actually markets repricing.
This whole year has been a year of a market that's been on its toes and on edge.
The S&P 500, the market is controlling its emotions.
I'm not surprised that we can get a nice rally if we maintain the status quo.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Your equity market totally unchanged this morning. We start in the bond market, 2-year, 5-year, 10-year, 30-year in the last 24 hours. TK, cycle highs.
Global Wall Street's focused, and more importantly, quickly, non-global Wall Street is going to get really, really focused. There has been a shift. Is it because of Israel? It could be this, that, the other thing. The fact is, statistically, we've reached a tipping point in the bond market.
Is this a substitute for further action from the Federal Reserve? I think that's the question on everyone's lips today. Bramo, Chairman Powell just around the corner.
Yeah, he's going to be speaking today at noon, and we're looking forward to that. Yesterday, Tom Barkin basically said the problem with it allowing the long end to do the work for you is it moves, and this is the problem, although right now it seems to be moving in an even more restrictive place. I'm just curious, the fact that we had risk off yesterday, and at the same time, we saw bond yields breach the highest levels going back 16, 17 years across the curve. What does that tell you about the new haven status of the U.S. Treasury market? I think that is going to be a real underlying angst for a lot of people in this market.
The communication from the Federal Reserve so far, we can wait. Governor Waller of the Federal Reserve, TK, we can wait. It looks like they're willing to wait for more data, not going into December, not going into November rather, but going into the December meeting later this year.
And the arch question is, do they look at economic data or they look at market data? I don't want to slow the show down now with a bunch of drawdown on bonds, but the fact is there are bond losses right now, absolutely critical.
Well, and this is going to be an issue going forward. At what point does it become market dysfunction? So far, it hasn't. So all systems a go. But at what point does it really cause nervousness about the realized losses, which are substantial, yet haven't necessarily been realized yet?
Chairman Powell coming up a little bit later. Look out for that Economic Club in New York. Bramo's going to give you the time for it in just a second. Let's start with two names in the pre-market. Tesla, Netflix. Different stories. Tesla right now negative by 4.7%. Netflix subscribers look good, Bramo. The stock is up by 13.6% in the pre-market.
So they're cracking down on password sharing, and people were worried that maybe there would be those that just simply canceled their subscriptions to Netflix. It turns out they didn't, and that seems to be being heralded. They're raising prices. Yeah, there's some headwinds. But the gain in those shares, after all of the other gains that we've seen this year, just shows you how much more dynamism there is left in some of these entertainment names that have gotten beaten up over the past couple of months.
Let's get to Tesla as well, because Elon Musk is starting to sound a little bit like Jamie Dimon talking about storms. Elon Musk had this to say: we're not going to sink, but even a great ship, Tom, in a storm has challenges.
What are you going to do with your Cybertruck on Fifth Avenue?
Gets delivered in November, can't wait.
It's coming in November.
I watched the I thought of you yesterday. I knew this would happen. The numbers dropped yesterday. I'm sitting at the Bloomberg terminal, miss, squirrel. And I knew you'd run with a squirrel.
100%.
Cybertruck gets delivered in November.
The Cybertruck gets delivered. What happens when you drive into the back end of one of those things?
Got no idea.
Imagine
the damage
Toyota
done.
Eviscerated.
Can you imagine the damage done?
I don't get it. I looked at the FA screen, folks. I am not a pro on this. My basic take is it's an auto company, not a tech company. You know, that's my amateur take.
More on this a little bit later. Tesla in the pre-market down by about 5% on the year, soaring by something like 100%. That stock this year is doing okay, better than okay. In a broader equity market on the S&P 500, slightly softer, negative by about 0.1% on the S&P. Yields a little higher, up 4 basis points. We are on 5% watch on a 10-year. And Lisa, a little bit earlier, came very, very close, 495.77.
And this came even with a 30-year auction, or excuse me, a 20-year auction yesterday that wasn't terrible. So that should have been good news, and yet it wasn't. Today, as far as the economic data goes, 8:30 a.m., we get U.S. initial jobless claims. Very curious to see whether we start to see more softness in the hard data. It has flatlined. If you take a look, there was that pandemic blip, and then you've seen jobless claims come in around 200,000 week after week after week. What will it take to break the trend? Today, Fed Speak includes, before the main event, just to give you a sense, Fed Vice Chair Philip Jefferson, Chicago Fed President Austin Goolsbee, Fed Vice Chair for Supervision Michael Barr, Atlanta Fed President Raphael Bostic, Philadelphia Fed President Patrick Harker, Dallas Fed President Lori Logan. The main event, of course, is Fed Chair Jay Powell at noon at the New York Economic Club in conversation with our very own David Weston. What does he signal in terms of hawkish versus dovish? A lot of people are expecting a hawkish tone to sort of counter some of the potential. I actually agree with you.
I don't think it matters. This bond market, and we are so distracted, John. I know we have to get to Oliver Crook in Tel Aviv here quickly. You know, my first question to the chairman is,
what is
Chairman Powell, yesterday on the Bloomberg terminal, a 30-year mortgage is 8.00%. What are you going to do? And then bite my lip.
Just want to finish up here. 8 p.m., President Biden is going to be talking about aid to Ukraine and Israel, and this pairs into the bond debate. He's going to probably ask for $100 billion in aid. Mm-hmm. How much does that really feed into some of the reaction that we've been seeing in the bond market?
It's getting more expensive, that's for sure. Let's start in Israel. Bloomberg's Ollie Crook in Tel Aviv. Ollie, wonderful to catch up with you, buddy, as always. The president leaving behind a tightly coiled spring. What did we achieve in the last 24 hours?
Yeah, tightly coiled spring, and I think that we achieved all that we could really hope to achieve from a president who's only going to Israel and not going to Jordan, as was the original plan, and that is the message of support to Israel, which we've heard reiterated again and again. Deterrence, American policy on this is succinct, and it's one word, it's don't. It's one word backed by 2 naval fleets and 2,000 troops on high alerts. If you're wondering how the Israelis have reacted to the visit, we got the front page of Haaretz here, where you can see Benjamin Netanyahu, Joe Biden embracing on the tarmac upon his arrival, the headline reading that his significant aid will come to Israel and that Biden backs the position that they did not bomb the hospital. What was left for the Arab world and the Palestinians is another question. That diplomacy didn't happen. And in a story where there is so much happening, so much talking, so much military activity, the headlines are still the same. You have aid stuck on the border of southern Gaza in Egypt that cannot cross over.
Oliver, when will the military act? I know it's an unfair question surrounded by secrecy, but this is like this week, momentarily in a few days, or is it out there somewhere after substantial bombing?
Listen, all we can do is read the tea leaves from the signals that we have gotten from, the U.S. officials and obviously from Israeli officials. The when is the question on everyone's mind. No one has an answer. People will speculate that while there are leaders from the West in Israel, perhaps that is not a time for them to move in. Rishi Sunak is here today and tomorrow. But again, Tom, I would also caution that there's the when, but then it's also the what, because the Israelis have also been saying don't expect necessarily a full land invasion where there's an occupation of Gaza. This could be much more tactical. This could be much more limited, but as a result, it could take a lot more time.
Ollie, you've done a tremendous job for us over the last couple of days. Looking forward to catching up with you a little bit later this morning. Ollie Crook there on the ground in Tel Aviv. Joining us now is Norman Rule, former senior U.S. intelligence official and senior advisor at the CSIS Transnational Threats Project. Norman, if I may, I want to start with a quote from the President of the United States, Joe Biden. Here's the quote. I caution this. While you feel that rage, don't be consumed by it. After 9/11, we were enraged in the United States, and we sought justice and got justice. We also made mistakes. Norman, what do you think he's alluding to there?
Good morning. The president and a number of his advisors firmly believe that the post 9/11 years drew the United States into a dark place of extrajudicial handling of detainees. It hurt our relations with a number of countries. It drew us into a 20-year war in a variety of locations. We forgot to think about how this ends and more about how we spent more time thinking about how this continues. And he's just advising the Israelis, don't do this. Now, that's fairly easy to say, and for the Israelis, they get it, but the problem is coming forward with a campaign that achieves their strategic and tactical goals without drawing them into this conflict is a challenge. We are off the map in many ways for both parties.
Well, Norman, this comes at a time where not only are we dealing with hot wars, we're also dealing with information wars. From a messaging standpoint, is Israel losing the room as some of these headlines come forward, regardless of their veracity?
Israel has had a very difficult room in the Arab world. Arab press has stood with the Palestinians, unsurprisingly, and the narrative regarding the El Ahla hospital bombing has been consistently anti-Israeli. So there was very little hope that Israel would achieve any gains in that direction. I think part of the president's trip to Israel and his work tonight during the speech will be to shape the U.S. domestic audience, where we've seen a number of protests, to include anti-Israeli protests in the U.S. Capitol yesterday.
Norman, does the Israeli intelligence have people on the ground in Gaza? Do they have any working knowledge of the makeup, the demographic, the people that are within that 25-mile strip?
Israel has traditionally had superb coverage of the dynamic within Gaza, and the fact that overnight they have eliminated the Hamas security chief demonstrates rather clearly that they're able to locate, identify, and neutralize officials who have a pretty strong sense of their personal security. But this is a labyrinthine, complicated area with hundreds of miles of tunnels. Very difficult to follow.
Do you presume that any military, given the geography, the makeup, the urban nature of it, is benefited by acting quickly or being patient?
Being patient. And the Israelis are undertaking an air campaign at present, which is not only eliminating Hamas senior officials, but is reducing their availability of weapons, command and control centers, shaping the battle space so when they do go in, they have a better understanding of where they must operate and areas they don't have to focus.
Norma, can you give us some sense of how we can read some of the rhetoric about whether Hezbollah is getting that much more involved and whether Israel is preparing for something more substantial in terms of attacking on the northern border?
Lebanese Hezbollah's activities in the north have been consistent and increasing modestly over the last few days. There are about 10 to 12 attacks a day. They consist of mortar fire, anti-tank missiles, and some small incursions. It's across the entire Israeli border. Israel has pulled back its population from 2 kilometers, will likely increase that to 5 kilometers. At present, the conditions with the Israel-Hamas conflict are not quite what Lebanese Hezbollah would need to ignite an entire conflict, which would significantly damage all of its political and material equities in Lebanon.
Norman, for more than a week now, there's been this sense that the full ground invasion was imminent. Over the last few days, that's kind of faded, just a touch. Norman, do you get the sense that something's changed in the operational plans? You know the famous line that all plans fail on first contact, but do you sense something has changed in the last few days?
Great question. In part, this was an information operation, but the Israelis are very careful planners for military events. I don't think there was ever a likelihood there would be a knee-jerk response, and unless they had a plan in the can for an invasion, which is unlikely, it would take some time. But we shouldn't discount that a type of incursion could happen at any time. They also have been pressured by the United States and a number of European partners to be very careful of civilian casualties, and that's causing them to develop a different type of approach to this target set.
Does that mean more targeted operations until we get full clarity on hostages in Gaza?
I think there's certainly going to be more targeted operations, even with a ground assault. With a ground assault, you're going to be moving people throughout Gaza to include Hamas leadership. And as they move, they become vulnerable to attack. But the hostage issue is a serious complication because it also means you don't want to attack places where hostages are located. You need to have intelligence to say when you do attack a place, there aren't hostages there. So that does introduce some careful thinking into attack planning.
Norman, your insight's been incredibly valuable to us over the last few weeks. We appreciate it and hope to catch up again soon. Norman Rule there on the latest on the ground in Israel. Said it to Ollie, Tom, the president leaving behind a tightly coiled spring in Israel.
Well, the coiled spring's there, and I really take issue with everybody's doing a walk by. We're doing modern, Lisa, I'll let you decide, modern TV diplomacy. The governor of New York State is making a walk through. The Prime Minister of the United Kingdom is walking through. The President of the United States, with all the heritage of the two countries. It's a military, this is a war, and I wonder what's going to happen in the next 48 hours.
Well, and there's a real key question of how do you hold the room, not just within the Arab world, but also beyond, as you try to keep going forward in the support in Israel.
Full team coverage still ahead on this program and coverage of this market as well. Coming up, Seema Shah of Principal Asset Management with your 10-year yield getting closer and closer to 5%. Chairman Powell coming up a little bit later this afternoon from New York. Good morning.
Today, the Economic Club of New York hosts a conversation between Fed Chair Jay Powell and Bloomberg Wall Street Week's David Weston. Recession risk, inflation outlook, real estate amid high rates, and more. The live interview happens today at 12 p.m. Eastern on Bloomberg. Context changes everything.
I'll be looking carefully at the data to see whether the real side of the economy begins to cool off or whether prices, the nominal side of the economy, heat up. As of today, it is too soon to tell. Consequently, I believe we can wait, watch, and see how the economy evolves before making definitive moves on the path of the policy rate.
There's one line that matters there. I believe we can wait. Christopher Waller there, the Fed governor, going into the November meeting. I believe we can wait, even as the data comes in a little hotter than expected. Will we get another round of that data going into the December meeting? Big one a little bit later, noon Eastern. Chairman Powell with David Weston at the Economic Club in New York. Noon Eastern TK with the big question we're asking all morning. The moves we've seen in this bond market, are they a substitute for further action from his central bank?
They're nonlinear, and they are what we call quadratic, which means they don't go step by step like the Three Stooges, inch by inch. As they move, they become bigger, and some would suggest bigger became yesterday, John. I'm looking at the first print on the U.S. 10-year real yield, and for my editorial judgment, it is an unimaginable 2.52%. It was 3 cups of coffee ago. I thought we'd never get to 2.2. We're at 2.5.
The nominal yield on a 10-year really, really close to 5%. Check out the price action now. Higher the session, 497.91. Currently on the 10-year at the moment, we're at 495.56. Yields up by 4 basis points. In the past 24 hours, this morning, yesterday, we've seen cycle highs on a 2-year, 5-year, 10-year, 30-year yield. Your 30-year still above 5%. Your 2-year at 5.24. Up a couple of basis points this morning. The euro trying to recover 105.46 on their currency pair. Bit of euro strength, that pair positive by 0.1%. Crude pulling back. We can talk about this a little bit more a little bit later. But 87 on WTI, we're down 1.4%. We mentioned this earlier in the week. Watch out Venezuela. Bramo. Sanctions easing on Venezuelan crude.
And this morning saying that they're going to increase their production, softening ties at a time. The cynic will say it is a very convenient time to say things have gotten better there because it is better to get on the margins more oil production at a time of potential disruption in the Middle East.
Brent crude a break of 90, Tom 89.99.
Under 90, our first brief this morning of this debt market, and we are thrilled to bring you Seema Shah, Chief Global Strategist, Principal Asset Management. Seema, in the zeitgeist this morning, is something changed yesterday, maybe something changed over the last 48 hours. Is it nonlinear? Is it quadratic? Is there convexity? Did something change in the last day?
It certainly feels like there is a different level of momentum going on in the market at the moment. We do think we're getting closer to a top. Certainly, we've had a long-held view. We've discussed this many times with you. We are expecting a slowdown. It is definitely not showing any signs of coming through at this stage. I think that's what really bond yields are responding to at this point. But of course, the further that yields rise, the greater the chance that a slowdown is going to be even deeper. Now, momentum can take you pretty far, and there's a number of other factors, as you've discussed in the program many times over again. Deficit issuance, Bank of Japan. There's so many things that probably mean that the floor for bond yields is higher. But certainly we do think that as soon as you do get clear evidence of economic slowdown, and as long as we get a very clear signal from the Fed, whether it's Powell today or later on, that should really mark the peak for 10-year bond yields.
Okay, well, what I'm going to do, folks, is give you the perspective, but not all at once. We're going to drip these data points in to show the losses that are being taken. Just since early April, the 10-year yield is down in price 12 shocking %. So, Seema, your question, if you were doing the interview today and not David Weston, do you say to Chairman Powell, sir, are you even aware of the acceleration of higher yields?
Well, look, I think it's a bit unfair because actually for the Fed, just like the rest of us, we're all trying to decipher what is driving this 10-year, this move up in bond yields. Is it term premium? Is it the move up in neutral rates? And that is going to be really important for how the Fed moves on in its decision. Now, it's very difficult to figure out exactly what proportion is driven by which. So equally, I think the Federal Reserve themselves are trying to figure it out. You hear it from a number of speakers over the past couple of weeks, is that is what they're trying to figure out. And as long as they don't have an answer to that, then it probably does make sense for the Fed to stay on hold. But of course, there's so many risks on either side that each moment that we don't know is somewhat damaging to financial markets and potentially to the economy as well.
Seema, do you consider treasuries still to be a haven asset?
Because, you know, looking at the way that things are moving in the last 24 hours, I think you do have to question that, certainly. You know, given what's been going on from a geopolitical front and the fact that Treasury yields continue to rise, and the fact that actually gold has rallied, you know, it does set that question. But I think the thing is, at the moment, the market is so specifically focused on the strength of the economy, what the Fed is going to do, that they're almost thinking about the safe havens as other assets. Now, let's get beyond this phase of uncertainty with regards to the bond market. And yeah, I do think treasuries will return as a safe haven, as a choice. But at this point in time, there's so many different forces which are buffeting the bond space that it's difficult to really say with great conviction that today treasuries are your safe haven.
There's an irony baked into a lot of the conversations that we've been having with certain investment managers who are saying that risk assets are the new havens, that essentially corporate America and the corporations that have immunized their balance sheets are essentially in better financial shape than the U.S. government, than a lot of the sovereign governments that used to be the stalwarts. Do you believe that? Do you think that traditional risk assets, including some of the stocks that have been the highest flyers, are increasingly the haven assets of the moment?
Well, I think that's true to some extent, and you definitely do hear that from clients and the way that they're talking about it. It's not everything by any means. It's very, very specific. You know, people want the big balance sheet. They want something which they know is going to provide stability, and something specifically that they know is, you know, they have some understanding over a longer term. So, you know, they look at the short term and say, okay, this is very difficult, but at least over a longer term period, there are secular trends that we can put our trust in. So yes, from that perspective, maybe there are a few corporates who have that strength, and most importantly, will be able to withstand any further upward pressure from treasuries. But it is a very difficult environment for investors, I think, today. And actually, it just makes more sense in that case to try and look beyond, as difficult as it is, to try and look beyond the next month, 2-3 months, and try and have a bit of a 6-month, 1-year outlook. That is very important today.
You had a tour of duty at Treasury, and you were very aware, obviously, with Principal Global, of the United Kingdom bond debacle, debt debacle, pension debacle of a number of quarters ago. Do you feel we're at a point of institutional risk where the degrees of freedom of bond managers with actuarial assumptions can't get it done, and we become unstable within our conservative institutional money?
I'll tell you, that is a question I've been getting a lot of within the last 24 hours. As you're getting close to that 5% point, that is the main question. But I have to say, look, we are not detecting any clear signs of financial stress. These numbers are certainly, I guess, concerning. We actually think that the system can withstand rates getting to 5.5%. The most important point, of course, is how quickly they can get
that's
there.
important, Seema. You're saying the financial system can withstand a move to a 10-year U.S. 5.50%?
As long as it is backed up by strong economic growth. So again, it comes back to what is driving yields higher. If it's because the strength of the U.S. economy is that resilient and inflation is maybe a little bit contained, then yeah, I think that the system can withstand it. But I also have to clarify here as well that, look, with financial risks, it's typically not in the area that you're looking at. So it's probably not going to be from the pension system. It probably won't even be from the banking system, because it has been ring-fenced by the Fed. So, you know, typically financial risks, as they arise, when they arise, it's in the place that you're not looking. So we have to be a little bit humble about this, and investors everywhere have to be saying, you know, maybe we can't see any risks today, but there has to be some kind of defense within your portfolios, potentially to kind of withstand anything that could arise as obviously we get closer and closer to that point where the frictions start to come up.
Seema, we've got to leave it there. Seema Shah there of Principal Asset Management. I know the year's been long, but did we forget that a bunch of banks failed earlier this year? Hasn't the risk materialised already? And we're talking about handling 5.5%. What happened in spring?
It was on the margins. It was specific stories. It was a liquidity issue. They've been solved by the Fed.
Did break.
Yeah.
We'll continue this conversation. Equities on the S&P, totally unchanged from New York. This is Bloomberg. The S&P 500 was up on the week. It's down on the week now. It's just about unchanged on the session. On the S&P 500 going absolutely nowhere. On the Nasdaq positive by 0.15%. We'll talk about the big move higher we're seeing in Netflix this morning in just a moment. Let's talk about the big move higher in bond yields over the last few weeks. 2-year, 10-year, 30-year. Throw in the 5-year. We're talking about cycle highs over the last 24 hours. A 10-year that gets closer and closer, Lisa, to 5%. 495.77.
And the move has been dramatic, and it has come even though there has been risk aversion. And to me, this is the key point. And we heard this just then from Seema Shah. At what point does that send the biggest message that amid risk aversion during the conflict in the Middle East, we could see that treasuries are not a haven?
TK, you've been thinking about another aspect of this as well. The price loss that we've seen at the long end of the curve.
Yeah.
In some places, I talked about the gilt mark in the UK recently. We're talking about losses of something like 50 to 60%,
right,
depending on which security you look at. And a question I think we've got to ask, Tom, have we fully realised the pain associated with those losses in this bond market?
This is something third rail for me, right, John? I was in 3rd Avenue having fine dining at McDonald's, and a guy came up to me and he said, "Thank you for mentioning what people really feel." And there is a separateness right now of institutional Frank Fabozzi bond dynamics from the real world of the pension people I mentioned with Seema and others of -10, -12, -18%.
One of our guests came on and said if she could find a 30-year treasury selling at 50 cents in the dollar, 40 cents in the dollar, she'd buy it, but you can't because they're not for sale. And this is the key point. To your point, they're not being realized. The forced sales are going to be the key question, which go to the point, when do you see big flows out of treasuries in a way that does force the hand of some investors?
I know we got to get to under surveillance, John, but what I would say is you can think as hard as you can about this, you never can see it coming. I can't tell you where the fixed income drama is going to be.
Always surprise.
Yeah.
Always a shock. Let's turn to the commodity market. Look at Brent. Look at WTI. The move in crude today. Just south of 90 on Brent today. Just about north of it at the moment. $90 and about 5 cents. We're down on the session, though, by 1.6%. We've had 3 levers to pull. The SPR. We drained that. Iran. Maybe turning a blind eye to production out of Iran. Can't do that anymore. I'm being very cynical, I know.
Yes, you are.
And then the third story, why don't we ease sanctions on Venezuelan crude? This was Javier Blas has been talking about this now for months. And Lisa, here we are.
Ding, ding, ding. We'll take that door.
Right.
For 500, Alex. So this is sort of what we're seeing right now, is that they are going to relax sanctions on Venezuela. A story this morning on the Bloomberg talking about how Venezuela is poised to increase production by 25% in the very near future. So maybe they'll be even a bigger marginal player since they aren't necessarily one of the major producers out there.
That works out at about 200,000 more barrels of crude a day out of Venezuela. Under surveillance this morning, President Biden delivering an address to the nation at 8 p.m. Eastern on the Israel-Hamas war and Ukraine following his brief trip to Tel Aviv. Biden saying as many as 20 truckloads of humanitarian aid will be able to enter Gaza through neighboring Egypt, with Israel saying it will only allow the aid to enter southern Gaza if it's certain, Tom, that none will be diverted to Hamas.
I'd like to see a good article right now on the 25 kilometers north to south from Gaza, pretty much up near the north of the Gaza Strip, down to Rafah, is it, Lisa? And to see where Israel's focused. And that allows the humanitarian trucks to get in if they're not focused within, I'll pontificate, 6 kilometers of Rafah and the southern border.
The more I read about this, the less clarity I have on who's holding it up, on what the issues actually are, and how accessible the roads and the infrastructure there are to deliver aid. How do you parse out individuals in Gaza from Hamas? How do you deal with the fact of checking each truck? What is Egypt's main hang-ups? These are all uncertain things, and the more I read, the more confused I get.
With tremendous difficulty and very little clarity, Bramo, to your point. Second story for you, Chinese investors selling the most US securities in 4 years in the month of August. $21 billion of sales coming to shore up the yuan as the onshore yuan fell to its lowest level against the dollar since last November. This is what Macquarie's got to say. This could be to liquidate some bond holdings to obtain US dollar cash in case it's needed later to defend the yuan via intervention operations. Mohamed Al-Arian's talked about this now for weeks. We have lost the anchors to this treasury market. The foreign buying, the BOJ, the European Central Bank, take your pick right now, Bramo, QT, whatever it is, we've got problems.
These are data from August. It raises a question of how consistent some of those sales have been. The point being that there isn't the price-insensitive buyer, to use Dalip Singh's phrase of PGIM fixed income, that there used to be. Is this what's behind the increase in yields? If it is not changing anytime soon. And I think that is what's driving some angst and a lack of conviction around a number of bond investors.
Just a real loss of predictable sources of demand. I think Dalip's done a great job of that over the last month or so. Two names I want to talk about in the equity market, Tesla, Netflix. Elon Musk seeing a stormy outlook ahead for Tesla. Rising interest rates, weakening consumer strength colliding with the company's rapid expansion. Musk saying this, we're not going to sink, but even a great ship in a storm has challenges. The company reporting third quarter profit and sales that fell below estimates. Tom, that stock is down by almost 5%.
Yeah, Graham Dodd and Cottle 101. I look for operating leverage. The revenue story is really remarkable. I mean, what this guy's doing in terms of bringing in money is great, but it's not showing up down the income statement. He does not have operating leverage at play.
Can we check out Netflix as well?
They
Look
do
at this
have
move.
operating leverage at play.
They got a serious move in a pre-market, higher by more than 13%. Brighter forecast for Netflix. The service set to raise prices in the US, the UK and France. Subscriber gains, Bramo, looking good. The stock outperforming this morning.
And the fact that they can raise prices and they can crack down on password sharing and still get and maintain their subscribers and still be able to deliver bigger earnings beat tells you where we are. And it raises questions on a macro level about the stickiness of inflation. I mean, if you think about the debundling, right, this idea of Netflix and Paramount and all of the other payments that you're making, we were supposed to hear that people were going to crack down on this and pull back. They didn't. And I think that's important.
Tells you a lot about the taste of consumers too, doesn't it?
Yeah.
That they're willing to watch Suits. They're willing to watch Suits. Telling me that the big blockbuster of Netflix in the last quarter was reruns of Suits.
Okay, really? You're going to... Okay.
I'm serious.
No, it's true.
It's true, well, it's a different demographic.
Are you watching Beckham? That's what counts.
I have watched that, yeah.
What do you think?
It was quite nostalgic. Good documentary. I thought it was going to be about the both of them. It's much more about him.
Yeah.
And his football
Did
career.
he really? Was he really the one that made the football curve?
You mean, was he a great
Bend it?
free kick taker? Yeah, sure. I think what's interesting is I think Americans think David Beckham was better at football than he actually was. And I think in Europe we were aware that he actually wasn't that good.
But he just was
to
very
such an extent that I actually think he was underrated in Europe and perhaps overrated in America, if that makes sense.
It does make sense.
Okay.
It's all about the image, maybe, in the U.S. and maybe less about substance.
The man and how he looked.
Yeah.
Okay.
And some of the...
Amy,
maybe.
thank you so much for watching the show today. She says Suits is a great show. She thinks it's Shakespearean.
I think it's important. Look, we've got a writer's strike. We had one anyway. Still got an actor's strike.
Yep.
See if that continues. So their blockbuster was Suits. Okay. You want to watch reruns of Suits and Meghan Markle?
Jeff Yu has not
I'll take a
watched
pass.
Suits.
I'll take a pass.
Joining us now, Jeffrey Yu, Senior Market Strategist and Beckham Analysis at BNY Mellon. We're thrilled he could join this morning. Jeff, I'm dropping in the debacle of the moment here slowly across 3 hours of surveillance. In an emerging market, the MSCI EM from the top is down 34%. Jeff Yu, to begin, how bad is it out there?
There's just very, very limited interest in moving into EM assets, full stop. We're not big fans of EM equities at this point, notwithstanding the China supposed stimulus push. We like EM bonds, but looking at our flow data, there's just very little take-up. You've got good real yields in LATAM, for example. You don't need to take that much FX risk. But again, with front-end dollar offering you 5% plus, I don't think anyone's biting the EM cake right now.
Jeff Lisa's been asking this question all morning. Let's get into it. Where'd you hide? Do treasuries work anymore?
Mm-hmm. Well, looking at over the last 2 weeks or so, where have we seen some marginal increase due to a combination of factors? Look at the Swiss, that is moving. Look at sterling, we're finding gilt, so gilt flows are moving forward as well. And we're finding interest in JGBs, not necessarily in yen, but people don't want to reduce their exposure to Japanese assets at this point. So it feels like, A, people are very, very long dollars. They don't want to add to that, but B, people are looking for safety alternatives.
Jeff, there's a question about whether we're seeing in real time a structural shift in some of the benchmark U.S. asset buyer base, whether we are seeing a fundamental withdrawal from Chinese, from Japanese investors. Do you see the evidence of that, or do you think that story has been overplayed?
We are starting to see evidence, well, I would say more evidence of that. Initially, we thought it was overplayed, looking at our flow monitors that have foreign investors being strong sellers, not in the way that people have been talking about. But now, that is them starting to show up more in data. But what are the reasons behind it? Is it, do the Asian central banks need to liquidate US holdings to prop up their own currencies, or do they worry about the US deficit moving up ahead? So those are two very different stories right there. But given that the market, the whole international asset base is still quite overweight dollars, that just doesn't bode well for dollar interest or US asset interest at this point. On a structural view, I'm still not so sure.
Overnight, there was a former member of the board at the Bank of Japan who came out and said that it's possible for them to abandon negative rate policies as soon as later this year. Do you think that that has basically been baked into markets already, or is that another shoe to drop when it comes to some of the flow dynamics pushing yields higher?
Sure, it's been steadily being baked into markets. As I said earlier, people don't want to be short yen anymore. So I look at our flow data for cross-border investors. There's a very small long yen position in place ready to capture that. But the other side of the coin is if more Japanese money stays in Japan, that has asset allocation implications globally, not just for treasuries. I'd worry about European and US corporate credit as well.
Jeffrey, when does the real yield impinge the system? If we look at the inflation-adjusted yield is basically the cost of capital, the lodestone, the foundation. We're sort of there, but what's your single point number where the 10-year U.S. real yield affects us all?
Well, when you actually have real yields push through, 1 percentage point, 2 percentage points, for a developed economy. I think that's where the pain really starts to come through, because then you really start to struggle to make the case for real income growth. For real income growth in the US to reach 1%, 2%, that is to be celebrated. But if that's going to be offset by the cost in servicing your debt in real terms, right, then everything negates itself. We've seen that happen in LATAM already, 4-5% real yields in various economies, and that's really starting to slow things. You want a lower number for developed economies, especially for the US and maybe for the Eurozone, but we are certainly heading in that direction. But then again, it's contingent on, in the US, the difference is, people's debts, especially mortgages, that's at fixed rates, whereas in the UK and some other places like Australia, Scandinavia, that's a bit more floating. So the transmission is different in different areas.
Jeff, help David Weston this morning. He's sitting down with Chairman Powell a little bit later on this afternoon. What would you ask him?
So has the market done your job for you? More and more FOMC members are sort of heading in that direction. I'd like to see a bit more conviction, because if that's the case, then you can fully price out any discount in markets relating to further rate hikes or things like that. And then it's purely a higher for longer story. And then we can look forward to the next phase of the cycle. But we need confirmation. And then where the Fed leads, the rest will follow. And I think especially emerging market central banks, they're going to be following it closely. Look at the Bank of Indonesia a few hours ago. Hiked, surprising. They're still worried about the Fed moving higher or Fed conditions weakening their own currency, and there may be a bit of a panic coming through across Asia. So that clarity is needed from the Fed.
Interesting. Jeff, thank you, sir. Jeffrey Yu of BNY Mellon, looking ahead to that sit-down, fireside conversation, fireside chat with David Weston and Chairman Powell at the Economic Club in New York at noon Eastern Time. That's the question right there. Is this chairman really willing to outsource monetary policy to the long end of the bond market? We get an endorsement of that later.
We had a guest off camera yesterday, off microphone, say this is the day where the Fed loses the narrative. They lose the script. And these speeches, all of a sudden, we make jokes about them. You know what? They may be important.
If he doesn't, and if he comes out and he says that we're going to hike rates, do you see the long end actually come down?
He's not going to.
No, but if he actually indicates a more hawkish stance, does that actually imbue more control over the long end, just because there is this feeling they're going to do more because of the economic momentum?
That is a dialogue for when the bond market didn't move. I don't think people understand the losses at this moment across portfolios. Nobody gives a damn about hawkish, dovish. They're like, what are you going to do about these yields? Silence, listen.
I love how closely you don't follow this at all.
I don't want to give my opinion. Thank you.
I know, but you will anyway.
Thank you.
Future's positive on the S&P. Bram Wheater and Madison and Wall on Netflix. Netflix up big time in early trading.
Keep getting better at monetizing that big and growing reach and engagement. So we believe we've got a long runway for growth in both kind of more membership and higher ARM over time in a more balanced way than what you saw this year, which was, again, a pretty unusual year.
Spencer Newman, the Netflix Chief Financial Officer. Netflix shares gaining in the pre-market after reporting its best subscriber growth in years. The company also announcing it's raising prices for customers in the US, UK and France. Brian Weeser and Madison and Wall writing this. Although a 15% price increase is significant, I know that it's likely the case that many, if not most, of Netflix's subscribers consume enough content to justify this cost, given the high volume of time spent, Tom, with the platform.
Yeah, we had Brian over this weekend, and he looked what was happening at the keynotes. We just had the CFO there, Stylen, from Netflix. John, am I losing it here? Do I need to get out of the suit and bow tie and get into full Patagonia?
That's the Midtown uniform.
Yeah.
And I'm against it. I can't stand it. I hate it. I saw two chaps walk across Park Avenue yesterday in their Midtown uniform, the Patagonia vests. No.
My favorite part of this entire show is when you start, going through an issue, and all of a sudden Tom just is like, oh.
I can see him at the corner of corner of my eye.
No, just absolutely going ballistic.
Just keep going.
No, but the guy
keep plowing through.
The guy for Netflix is going full Midtown.
Full Midtown uniform.
Yeah, that's all there is to it.
Look, if your stock's up, you can get away with it. Do whatever you want. Okay, if the stock's down, put on a suit. Okay. All right.
Ferro permission.
We're going to help you with your house, the streaming. John Ferro trying to cut down his cable TV bill by, 30% or something like that. Brian Weeser has been brilliant on this. Principal Senior Media Analyst, Madison and Wall, and he's really had an arch theme for a decade, which is don't give up on TV. Do you still hold that theme?
No.
TV, it's like finally done?
Yeah, we're over. I wrote something yesterday, earlier this week, where I calculated that the total amount of TV ad inventory is going to fall by about 24% at least under conservative assumptions.
Where does it go?
It goes away. People don't get as many ads going forward because even if people subscribe to an ad tier, they're not going to get the same ad loads, but not that many people are going to subscribe to ad tiers in the first place. They're going to take the increases in prices. They're going to cut their pay TV subscriptions to fund it.
When you look at this, and on a broad sense, Michael Mabusian, 17, 18 years ago, on the concentration of digital product, are we just going to concentrate down to 2 or 3 survivors?
I think that's possible. I think there's going to be 4 or 5 more likely, just a lot of very low profit players. But here's the big thing a lot of people aren't thinking about, that most of them can be global if they bother to invest in it. Netflix will, Disney will. We're not sure what Warner Discovery is doing. We're not sure how much Comcast will. They are. But I think that's the big thing, that they can play at a global level. So low profit, but double or triple the revenue. That's still a good business.
Do you remember the death of the PC?
Oh, yeah.
And it used to be that line that every person who wrote that headline wrote it on a PC. Slightly ironic, we're talking about the death of TV on TV.
On TV, yeah.
What lives on?
Well, to be
News,
clear,
sports?
Paid TV keeps growing.
Okay.
People will pay for it. It's advertising on television that is going to continue to decline. But consumers will pay for it.
So let's go to the Walt Disney Company. Where does it leave them and what do they do?
That's such a mess. I mean, here's the thing. Separating the network and the stations is kind of ridiculous. Separating the stations makes sense. You don't need that legacy infrastructure. Think about how you're going to position this company to merge with someone else. Having a regulated business like the broadcast stations combined with the network makes no sense, firstly. I don't know where they're going to go. They don't seem to have a very clear true north like they used to in 2018.
What do you think Iger was doing then? Just saying, come to me with some ideas?
I think so. I wonder, I have a theory that he was getting really good advice from a team he'd built up over the course of 15 years prior to 2018. You could tell they had clarity in what they were doing, and if they stuck to it, maybe it would have been worth less than it was in 2018, but it would have been a great 50-year business. Now, it's strategically all over the place. Are they going to split ESPN? What about A&E? I mean, there's all these businesses that they just don't have clarity around.
Lisa, help me at your house. At my house, nobody watches Disney Plus. They're glued to Netflix. Is that...
Yeah, but how old are they, right? I mean, how much is this a demographic issue?
Can Disney survive on the kids, and that?
To be clear, there is a very direct relationship between share of spend on content and share of viewing. Sounds kind of obvious, but if you increase the amount you spend on content, you'll get more viewing, right? And so if that follows, if Disney doubles the spend that they have on actual programming, they will get more viewership.
When's there the pushback point? when you do have consumers that say, I'm not going to pay for that? Have we seen anyone breach that? Or is this basically the sky's the limit? We're going to be paying, $1,000 a month for our entertainment.
You're hitting on some things I thought were kind of obvious in 2018 when I had a sell on Disney back then. But the point I was making was the cost for these services will be so much higher because you're going to churn. So Netflix can raise their prices 15%, but churn is going to go up too. Marketing is going to go up. The content delivery, of course, we're always going to be higher.
When you talk about churn, this basically means that people are going to leg in when they see content that they like, and they're going to leg out when they don't.
Consume the Beckham series and get out when you're done.
And Suits repeatedly, like Tom and John do every night. But I'm curious,
religiously,
about whether we also learned something from password sharing, and that crackdowns on that do not lead to a drop-off in revenues. In fact, you just capture more.
Yeah.
Is this going to lead to a broad policing of all the people out there who are still using their parents' subscriptions when they're 33?
I think so. And the more aggressive that Netflix or any streaming service is in doing that, again, it's going to lead to higher prices paid by consumers. But again, there's this pool right now of $100 billion being spent on legacy pay TV services. It's only $30 billion being spent on streaming. That's a lot of money to shift.
Tom and I talk about the bundle, the return of the bundle. What does the future look like? Is it the past?
I think it will look a lot like the past. I've called it John McCain's dream, right? Remember when he was in the House?
Explain that.
Okay. 2003, right? He was chairman of the House or the Senate House Energy Committee. They were trying to create an a la carte world. Do you remember this? Basically, they were trying to make it possible so you could sign off for a given network. That was a big deal in the cable industry. People like me, I was a cable analyst at Deutsche Bank at the time. We were saying, this is crazy. It's going to actually cause a worse business. It's going to make consumers are going to pay more, less marketing, less diversity of content, blah, blah, blah. Well, here we are 20 years later, and we got it. It's just at a slightly more aggregated level. But it's not positive for the economics of the business. Consumers might feel better about it, but they're going to pay more for the privilege.
What does sports do? I mean, sports is still mega bucks. It seems to me that's all people watch, sports and the weather, and Bloomberg surveillance. But what does sports do?
Sports is in a real worry right now because if basically the only people who are going to access sports are going to be those who keep with the pay TV bundle, you've got to really like your sports because you're going to be paying $150 or $200 a month. Exactly. Yeah. And I don't know.
John's up at $500 a month for English football.
Disney put out AK last night with breaking out ESPN for the first time. Fun reading, just to see just exactly how big it is. It's not a shocker on the sizing, but they're positioning to do something with that asset, which they probably should. Sports is the problem is sports risks going the way of boxing, right? Not that bad, but in the way that boxing used to be this broad-reaching thing that everyone accessed and consumed, and then it became pay-per-view, and then it stopped having casual fans.
Some of us had pro wrestling. And you get to the weekend just so you could watch 30 minutes in black and white.
I wish you could see Bramo's face as he's discussing pro wrestling.
Gorgeous George.
You do not watch pro wrestling.
On a serious note,
Gorgeous George was like religion, and then the Sheik came along.
There's a very interesting negotiation taking place in Italy with Italian football. There is a push by some of these leagues to go direct to the consumer, not to sell the rights, but go direct to the consumer. And I think you alluded to that slightly with boxing.
Yeah.
Is that the future for American sports?
Yeah. I think many of them are going to end up doing something like that.
So the NFL is going to have its own network, its own TV network, and just pushes the game straight out
itself. To be clear, they will still prefer to sell to multiple rights holders. And those multiple rights holders will end up pricing it very high. Right? But the point is, if right now 50-60% of the population might consume a little bit of sports, half of those people are passionate about the sports, half are kind of indifferent, that indifferent group won't pay.
There's a bigger question underpinning that, which is how much of the money goes to the content creators, right? The sports members, the athletes versus the writers versus artificial intelligence. Is there a sense that a greater proportion of the money will go to the creators?
Isn't this the perplexing thing with the strikes going on? The amount of spending on content has only gone up. Now, I think it's actually the showrunners who've been benefiting disproportionately, the Jerry Bruckheimers, the Shonda Rhimes, et cetera. That, I think, is where a lot of the money is going, and the distribution of talent around the world. I mean, think of how many people in England are now acting in a series running in the U.S., right, as an example, or all over the world. The talent has been distributed, and so the spending on content has been spread out. It's like a lot of other industries where we see offshoring in agencies or in other industries. It's the same thing for Hollywood. It's just the people in Los Angeles aren't necessarily the beneficiaries.
I saw you pointing at me then. An Englishman acting in a series.
Exactly.
In the US, is this acting?
This is Suits.
Kind of.
This
Suits.
is the Bloomberg Suits.
Is that what it is? Don't worry me, Bramo. Are you Meghan Markle?
No, please.
No, okay. Bram Weiser and Madison Wall. Is that an offensive thing to say?
No.
Okay, all right, interesting.
Let's just move on. Look at those bonds.
Look at those bonds, Brian. Good to see you. Coming up, we'll go to Tel Aviv for the latest with Bloomberg's Oliver Crook. Then we'll catch up with Cameron Dawson of New Edge Wealth. Let's turn to this bond market. Shaping up as follows in a treasury market in America. Cycle highs in the last 24 hours on a 2-year maturity, a 5-year, a 10-year, a 30-year. Your 10-year right now at 4 basis points, just south of 5% at 4.9535. Your equity market positive by not even 0.1% from New York City. This is Bloomberg.
Anytime you see rising economic and geopolitical uncertainty, that is bad for markets.
Are we going to see spillover effects in the Middle East? Are other countries going to get pulled into this? And you've seen actually markets repricing.
This whole year has been a year of a market that's been on its toes and on edge.
The S&P 500, the market is controlling its emotions.
I'm not surprised that we can get a nice rally if we maintain the status quo.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Today you will hear from both Chairman Powell and the President of the United States. Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio. Alongside Tom Keene and Lisa Abramowicz, I'm Jonathan Ferro. Your equity market slightly positive on the S&P 500 in this bond market. Wow, what a 24 hours. More headlines for you. Your 10-year at a cycle high, just short earlier on today, Tom, of 5%.
Can't convey the shift in the bond market. Really, in the last 2 days, it's been extraordinary. There's all sorts of fancy ways to look at it in the Bloomberg, but all you need to know, to use a non-physics word, it's like the car going down. It's like that Cybertruck going down the road. There's acceleration in hand here.
Coming to a neighbour near you in November, looking out for
Matt
that.
Miller, I think, down payment.
Has Miller ordered one, has he? That stock is slightly lower in the pre-market. Elon Musk talking about a storm for the automakers. That stock has been down by something like 4 to 5%. We'll talk about it later. Need to talk about the chairman of the Federal Reserve. Lisa, the big question, is he willing to outsource monetary policy to this bond market?
If he does, what does that do? If he says that, does he allow bond yields in the back end to climb? Because what this means is essentially the Fed is not going to raise rates as much to curtail inflation. They are just going to expect yields on the back end to curtail momentum. This really raises this big fundamental question to me, which is A, have they lost control? But B, do they think that yields are rising for a reason other than economic momentum that could be potentially inflationary?
Exactly where I wanted to go. Perplexing. The word that Neil Kashkari used over at the Minneapolis Federal Reserve. Do they have a decent understanding of what's underpinning this move in the long end? What is the dominant driver? I ask that question every day. I get different answers.
We don't know. Bottom line, we don't know. There is an issue of the deficit of the United States. There's an issue with the buyers over from Japan and over from China. There is an issue with inflation. There is an issue with growth. And there is an issue with this idea that consumers are still spending like they are Americans and like cash registers. 40
PhDs around the table helping Chairman Powell. David Weston will be around the table. It's a fireside chat today with the chairman. I'm going, John, to the 10-year real yield, and the fancy PhDs advising Chairman Powell, we're looking at 1.80. Oh, we'll begin modeling at 205 or 220. We're popping 250 right now.
Sure.
To borrow from the economists at Walt Disney at Burbank, it's a whole new world after all for Chairman Powell.
Governor Waller, we can wait. Will the chairman ultimately say the same thing? Data's coming hotter. PPI, CPI,
well, yeah,
retail
they're data
sales.
dependent.
Do they need another round of that before they can sit there with confidence and say, Tom, we're not sufficiently restricted?
You nail it. And there's the eco-babble. All of a sudden, the financial babble's folding into it. It's not two conversations. They're becoming one conversation.
Although, that said, nothing has broken except for the banks that went under in March. But there hasn't been necessarily the same kind of risk appetite.
I don't agree with that. That's an institutional Bloomberg Manhattan view. There is a retiree right now in Beloit, Wisconsin, who's going to open their October statement, John. They're hammered.
I thought you had more to say.
No, I don't have more to say. They're hammered.
Just the cadence of your voice. I thought you were going
all
further.
This spread
I'm not
stuff.
sure, just to jump in, I'm not sure what you're disagreeing with Lisa about, because ultimately something by definition
Lisa's
did break
talking
in the spring.
A wonderful, important, analytical debate, which Chairman Powell will love to address today. How about the retiree in Beloit who's down 14%
Sure.
with their $428,000 retirement plan?
Aren't they associated with the same thing, which is ultimately the long securities underwater if you bought it 3 years ago? and you sat on it.
The 3 years is the key phrase there. It's not the move or the level, it's the timeline, it's the x-axis.
Down something like 50 to 60%. And have we fully realised the pain associated with those losses at the long end? We've seen some of it come to the surface in the banking industry in the spring, and maybe more is still to come. Your market looks like this morning on the S&P. Enjoyed the rant, TK. Futures unchanged on the S&P 500.
Thursday rant.
Yields up. I disagree. About what? I'm not sure. Up 4 basis points.
Financial.
495.77 on a 10-year. Bramo, the euro, 105.54.
Over in the financial world in Wall Street, 8:30 a.m. we get U.S. initial jobless claims, and at 10 a.m. we get existing home sales. Do we get a tick up in the number of jobless filings? Today we do get a host of Fed speak from a host of different banks. We get Chicago, Atlanta, Philadelphia, Dallas. We hold a whole host, but the real main event is Fed Chair Jay Powell, who's going to be having a conversation with David Westin at the New York Economic Club today at noon. And at 8 p.m., President Biden is addressing the nation, and this really is one of the biggest mysteries. He's going to talk about potentially $100 billion in additional aid to help fuel some of the efforts by Israel and by Ukraine. Is the fiscal part of this a significant proportion of the increase in yields? And if so, this is going to be a longer-term problem that takes the conversation, John, away from the Fed and very much to the fundamental fiscal policymakers in Washington, D.C.
The president addressing the nation a little bit later on this evening. Let's address the airlines right now. New outlook for American Airlines. Here's the outlook now. Full-year adjusted EPS. Here's the range, $2.25 to $2.50. Previous range, $3 to $3.75. The estimate, $2.34. The stock is down by 1.4%. The airline stocks have been absolute dogs since July. It's been brutal, Bramo. Some of these names are down like 20, 30%.
American are down 39.
Yeah, but this to me is going to be an issue of how they really deal with the potential of increasing oil prices. And then all of a sudden disruptions. If we do get real disruptions in travel, we saw United really point to that with respect to flights to Israel.
Do you see Delta?
I did.
Changing their Air Miles rewards program all over again.
They got pushback from people who were medallion holders that they raised the bar a little bit too far.
Did you write it in?
I did not write in. I'm not going to use my position ever to influence anything.
I would never.
Of course not. You would. American Airlines down about 1%. Cameron Dawson with us, CIO at New Edge Wealth. Cameron, good morning.
Good morning.
Let's talk about the struggle for those airlines at the moment. Is that just one sector? Does that tell you something about consumer discretionary spending more broadly? What is it?
Yeah, where's Ozempic when you need it? I think that what we're seeing here is this dynamic that we are still very much in a late cycle economy, that there are winners and there are losers. There are those with pricing power and those without pricing power. You see it this morning, Netflix pricing power, Tesla no pricing power. That has something to do with small ticket item versus large ticket item, but it also has to do with interest rates. And the cost of capital makes the operating environment more difficult. So in late cycle, you have to be hyper selective when you're picking your equities because there will be those that stumble.
I love your note. You go right to the top line. You look at the nominal GDP inflation overlay. You've got the Magnificent Seven sales growth up something like 35% year over year. Nobody's talking about the top line.
Yeah, it's extraordinary. And part of that top line is because they have that great pricing power. Some of that is skewed by NVIDIA. It's pretty wild. NVIDIA is going to grow earnings by 1,000% this quarter. 1,000%. But even if you remove NVIDIA, the Magnificent Seven will still be growing earnings by 60%. So if you take out the Magnificent Seven from this quarter's earnings would be down 4% versus the down 1% to flat that's currently projected.
Is that priced in already?
I think it is. I think it is to an extent because you've seen so much multiple expansion. It doesn't mean that these still aren't great companies, but if you look at the direction of growth, it slows materially going into next year. What you see is NVIDIA, for example, 1,000% goes to 33%. You see similar decelerations for other Magnificent Seven names. The market cares about second derivatives. So I think it'll be a really interesting test for leadership next year as we see that deceleration.
John was asking about American Airlines and whether some of the disappointments that we've seen from American, from United, are specific to this sector or whether there's a broader withdrawal from consumer spending that you're seeing on the ground. Is there a dissonance between some of the official data and the anecdotal data like what we got in the Beige Book that points to a much more substantial slowing down?
Yeah, there is dissidence there. There's also dissidence within the credit card data. That was the big head scratcher. All the credit card data seemed to point to a slowing in consumer demand. We did not see that, of course, in retail sales. The best explanation I've heard of that is because the measurement period was after the credit card data was starting to roll over. So I think what we're starting to see is at the margin, consumer spending is starting to soften, but it's not broad enough yet that it's falling off a cliff. And part of that is just because the labor market still remains so tight and wage growth still remains rather robust.
So what's your prescription, except for load the boat on Apple? Julian Emanuel writes a piercing note today with Ed Hyman at Evercore ISI. They still are on recession 2024, but he says a defensive tilt is essential. Do you agree, or can you be more optimistic and buy shares today?
I think the defensives are certainly washed out. Right now, you look at big, huge put option buying within the staples, for example, utilities are very washed out, but they're still very much in downtrends. Our preferred way is to say we're willing to own cyclical names as long as they're high quality, meaning companies that have good balance sheets, have strong free cash flow, but the overlay on that has to be valuation discipline, because the higher you go in valuation, the more you have room to fall as valuations come in, as growth expectations come in.
Let's finish where you started, Ozempic. You've seen the performance of some of these packaged food stocks.
Yeah, they've just tanked.
Absolutely brutal.
Yeah.
It's brutal. Mondelez, Tom, down something like 20% since the peak earlier this year. How much is that stock, that company, going to change this market?
Look, I think that as long as what you're seeing is this shoot first, ask questions later, meaning that you're pricing in an impact of something that probably is going to take very many years to play out. And the fact that Walmart was already calling it out as far as weaker sales, that seems to be a really convenient excuse as to what they're seeing. So I wouldn't want to price all of that in. I think that's one of the reasons why staples likely are oversold at this point. It doesn't necessarily mean that they're going to lead the market in an uptrend, but there's some of that kind of inverse of what you're seeing in the optimism around the medical stocks.
So excuse, not a reason.
Yeah.
Okay, excuse, Bramo, not a reason.
I buy that completely for
Okay.
like the Walmarts and the snack companies. There is another story when it comes to healthcare companies that deal with some of the medical issues tied to morbid obesity. Because if you can treat that, and not just that, but Ozempic also is geared toward treating some other potential maladies, then that could be real because it's specific and targeted to individuals in certain places. That to me is more interesting.
What doesn't Ozempic do, based on what I've seen in the last few weeks?
It cooks your dinner, it tells
Right.
your kids to do their homework. It's fantastic.
I saw something about the kidneys.
Yeah,
in
well,
the
that's
last
the
year.
kidneys. It's like the whole host
Amazing.
of other issues that it can deal
Amazing.
with.
Cameron, thank you.
Thank you.
Cameron Dawson of New Edge Wealth. Wondering where we were taking the end of that conversation. It's going to stop there. If you're just joining us, welcome to the program. On the S&P 500, we're totally unchanged. We're negative by 0.01%. Yields are a little bit higher by 5 basis points. That's what we're focused on this morning. On the 10-year, 4.9641, getting closer and closer to 5%. Bank rate, mortgage in America. We'll discuss this a whole lot more later in the hour. But Lisa, 8%. 8%.
And basically what you're seeing is complete stasis in sales, dropping off a cliff, mortgage applications falling to the lowest in 28 years. We were talking about, well, things aren't really breaking, and Drew Mattis wrote in saying housing is broken. And a lot of people would say the housing market has broken because who is going to buy a home and take out a mortgage for 8%? It just increases the cost that much more dramatically at a time where prices are not coming down.
It's certainly frozen, that's for sure. TK, that housing market is totally frozen.
It's a separate thing. That's what Powell's going to say as part of the mix when he talks to David Weston today. But to me, John and Cameron, I thought was brilliant on this. I'm sorry, there's a real yield. And this is something a huge body of the public has never really confronted. 2.53% moments ago out to a new high real yield. And I don't know, John, 2.6, I don't know where the world falls apart. But every textbook tells me that's what to follow.
You know this is going to be a big deal in the election, what's going on in the housing market, access to the American dream at the moment. What's happened with the Federal Reserve, and we're still trying to realise the consequences of this, to have both record low interest rates and interest rates at multi-decade highs, both in the space of a couple of years, is absolutely amazing. And Tom, the fallout from that, the ripples that you see from it.
Yeah.
We've got a poll that we're going to talk about in just a moment, a Bloomberg News and Morning Consult poll. The President of the United States lagging behind the former President Donald Trump in some key states. Arizona, Georgia, Michigan, Nevada, North Carolina, Pennsylvania, Wisconsin. That conversation with Bloomberg's Anne-Marie up next.
Today, the Economic Club of New York hosts a conversation between Fed Chair Jay Powell and Bloomberg Wall Street Week's David Weston. Recession risk, inflation outlook, real estate amid high rates, and more. The live interview happens today at 12 p.m. Eastern on Bloomberg. Context changes everything.
If Hamas confiscates it or doesn't let it get through or just confiscates it, then it's going to end, because we're not going to be sending any humanitarian aid to Hamas if they're going to come be confiscated. That's the commitment that I've made.
The President of the United States speaking earlier today on Air Force One. Biden will address the nation tonight at 8 p.m. Eastern Time from the Oval Office. If you're just joining us, welcome to the program. Here's the price action on the S&P 500. Busy morning already on the S&P. Equity futures look like this. We're negative 0.05% in the bond market. It's kind of a wow 24 hours all over again. Up 5 basis points on a 10-year, Tom. 496.63.
Yields on the move. That's a benchmark to look at. We made a lot of the 30-year rather yesterday, going through 5%, 5.06%. But I would look at it, John, holistically and globally as well. Yeah, we focus on the 10-year. There's a lot more going on than that.
Let's finish on crude in the commodity market. You will notice Brent a little bit earlier today broke below 90. Conversation of the past day or so, easing sanctions on Venezuela. And as Lisa mentioned, potentially kicking output higher there by roughly 25%. A production boost there, Tom, potentially in Venezuela, connected to arguably what's developing in the Middle East.
I saw one report of migration and sending people back to Venezuela. To me, it's just a domestic stew of the Caribbean and Venezuela going over, decades and decades?
You don't think the timing is relevant
I think
here?
the timing here has a little bit to do with it,
87.33 on WTI. Brent crude, $90 and about 30 cents, Tom.
There it is. Right now, it is important that we get an update on Israel after all that we observed yesterday. We're advantaged by Anne-Marie Horton in Washington and Oliver Cook in Tel Aviv this morning. Anne-Marie, let me go to you first. The president looks exhausted. It has been an emotional 36 hours. What will President Biden do today?
Well, he's going to be making his only second Oval address. This is a direct appeal to the nation this evening at 8 p.m. And what the president is going to say is really try to make sure that he is explaining his foreign policy goals and explaining the need to continue to support the national security concerns of U.S. partners directly to the American people. So this is a direct appeal to the American people this evening, and it comes as we are expecting the White House to request more funding for Israel, more funding for Ukraine, as well as partners in the Indo-Pacific like Taiwan and border security from Congress. And we're reporting that funding request could be up to $100 billion. So this is the president taking that appeal after, on the heels of this trip to Israel, where he was able to sit down with Benjamin Netanyahu to really understand what is going on in the region. This is going to be his direct appeal to voters this evening.
Oliver Crook, what will the prime minister do today, and particularly what will the prime minister do in briefing and addressing his military?
So we heard from the prime minister of, well, it depends which prime minister you speak of, because we have the Israeli prime minister who obviously is at the center of this. We have the UK prime minister who is here now and has just spoken alongside Benjamin Netanyahu, giving some of the very same remarks that we heard from Biden yesterday. My read on it is a little bit more couched than the full-throated support, but basically the same message. In terms of Benjamin Netanyahu and the orders that he might give, again, we've been left guessing in terms of the when and what the ground incursion looks like. But as we've been talking about, Tom, the question is, what does this incursion look like? And is it going to be the full force rolling in occupation? I think that the Israelis have been sort of steering us away from that, thinking of more tactical, more discrete operations that may last a much longer time than that.
We've been talking, Oliver, and I do want to get Anne-Marie's take on some of the dissent in the United States. In Israel, how united are people around Netanyahu, a highly polarizing figure who has sort of been leading by proxy with a whole host of others with the war cabinet?
It's a very interesting question, Lisa, because, when I was here 7 months ago, the thing that defined Israeli politics was total dysfunction and a completely separated society. On the one side, where you had literally hundreds of thousands of people on the streets, it was a sight to behold every single Saturday, protesting the government and the judicial reforms that they were trying to push through. That, of course, has all gone silent in the last week and a half. But at some point, and you hear it a little bit under the surface, Netanyahu, in a lot of people's mind, is the person to blame for what has occurred here, particularly a prime minister who is has run with such a reputation on security. I think that a lot of people are waiting to have that conversation a little bit later once they're past the sort of initial wartime. But that is certainly under the surface here, Lisa.
Anne-Marie, this president, the president of the United States, is facing some real difficulties abroad. Ukraine, Israel, facing some at home as well going into an election year. Anne-Marie, as you know, together with Morning Consult, the team here at Bloomberg News has put together a poll, and it does not make for good reading for this president.
No, absolutely not. This poll shows that President Biden is losing in some key districts, some key swing states. And what's so notable about it is that a number of these swing states he actually won in 2020. So the 5 of the 7 swing states that Trump is beating Biden is Arizona, Georgia, North Carolina, Pennsylvania, and Wisconsin. They're all states, Jonathan, he won in 2020, except for North Carolina. And the underlining issue that this poll shows is that it's the economy that really has voters on edge, and the inflation that is their concern. And they think that Trump potentially can do a better job. Also, we're talking about what's going on in Israel. We're talking about the aid that Biden wants to request as well for Ukraine. When it comes to foreign policy, even though President Biden loves to tout that he was the chair of the Senate Foreign Relations, that he was a vice president, he is now commander in chief. This poll, Trump is leading 11 points when it comes to China and about 7 points when it comes to issues regarding Ukraine. Voters in these swing states think Trump is stronger on foreign policy than the current president.
Let's talk about energy then. All roads seem to lead to that right now, Anne-Marie. What can the president do? We talked about maybe moving some levers like easing sanctions on Venezuela. What can he do going into next year?
Well, I think there's one thing that we need to understand and know, and is that the U.S. right now is at record when it comes to energy production. This is something that I think gets lost in the headlines when you look at higher gasoline prices or a higher oil market. There is concern in the energy market, especially in the short term, what could happen given the fact that we do have a conflict now in the Middle East. And if Iran was to become part of this conflict, that would mean a massive spike to oil and energy prices. What we've seen from this administration is they are going to allow Venezuelan crude to start moving again. But this comes with the fact that Maduro has to have free elections, and the United States can slap those sanctions back on if they do not think that he is operating in good faith.
13 months before the US elections. MH, thank you. Ollie Crook. Ollie, stay safe, buddy. As always, Ollie, thank you. On the ground in Tel Aviv. This headline here, the front runner for the GOP nomination, the former President Donald Trump, leading Biden 47% to 43% among voters in Arizona, Tom, Georgia, Michigan, Nevada, North Carolina, Pennsylvania, and Wisconsin.
It's a good poll. The standard error of 1%. So the margin there, rather, is actually an adult margin and not a wish. What I find interesting is the lone state really glowing for President Biden is Nevada, which has, of course, Las Vegas and all of the labor towards the gambling industry.
Well, I wonder how much this kind of sentiment is going to really shape the speech that we hear tonight at 8 p.m. by President Biden to try to convince the American people to get on board with some of the initiatives that have gotten less popular as time has gone on. And I think this is sort of the dividing feature right now, is that both parties are looking for their North Star to sort of coalesce around. And they're both a little bit kind of moving away as the sort of further left, the further right are moving further from the center.
It's still early, but I do take the point that one of you mentioned, which is, you know what, it's always about the economy. We're all distracted by this horror in the Eastern Mediterranean, but the answer is it's about the economy. And, you know, to me, this yield move is the haves survive because of the haves, and the have-nots just get absolutely crushed, and that folds into the poll maybe more than anything.
I think the mystery remains the same for the Democrats, Tom. They're struggling with the following. they're going to cite the data. They're going to say things like, look at retail sales. Look at the trend for inflation. Look at the labour market, jobless claims around 200K.
Look at the FICO score to Bank of America.
Look at all that stuff. And then someone turns back around to them and says, yeah, ask them how they feel about it.
Right, my
and then you hear
grocery
from
bill.
consumers. And I'm sorry, you can't sit here and tell people they're wrong about how they feel by shoving data down their throats. It's about how they feel.
And disinflation is a very complicated kind of concept to explain politically.
Precisely.
When your bill's going up, period, full stop.
Terry Wiseman and Macquarie on foreign exchange and this bond market coming up next from New York City. This is Bloomberg. Equities pulling back just a touch on the S&P 500. Down on the week, down on the session. On the S&P right now, we're negative by 0.1%. Positive on the Nasdaq, up by 0.1%. Netflix, looking good. Subscriber numbers, nice. They've got the pricing power, as Conrad Dawson at New Edge was talking about. They can put prices up. Suits? Is that where the pricing power comes
100%.
from? Okay. In the bond market, we look like this. 2-year, 10-year, 30-year, cycle highs in the last 24 hours. 524.20 on a 2-year. Unreal. Up a couple of basis points again this morning. Up 6 on a 10-year. 497.27. Lisa, we're up 5% on a 30-year. We're getting closer on 10s.
The problem is we don't understand why, and the whole curve is moving to 5% and beyond. And this raises this real question of, is this a sign that we have more inflationary pressure than we ever would have imagined, as data point after data point is surprised to the upside? If that is the case, how does that crimp the U.S.'s borrowing capacity in a more material way going forward?
It's getting expensive.
Exactly.
Let's put it that way. What's the ask? 100 billion for aid, Ukraine, Israel, for the border? Is the president going to address that later on today?
I'm guessing he's not going to come out and say, last time I was looking at Bloomberg, I saw the 10-year yield close to around 5%, which might crimp our ability to borrow.
Maybe they should be sitting there looking at it. I said a few weeks ago, how close are we to them waking up every morning in Washington and starting to follow this? Tick by tick, really closely. Congressman French Hill was already there, straight off the bat was citing where the 10-year was. I wonder how far that spreads, Tom.
Again, this is the economic thing that we're very comfortable with, over to a careful financial analysis, and I would suggest it started 2 days ago. And the shock here this morning, John, I can't round it up yet, 2.53%, up 6 ginormous basis points on the 10-year real yield.
497.27 on the nominal yield. I want to finish on crude just briefly. Had this discussion a little bit earlier if you missed it. Easing sanctions on Venezuela, potentially boosting production there. There's a lot of nuances, technical features of that conversation, but ultimately crude pulling back a touch. $90.33 on Brent, on WTI $87.35. Under surveillance this morning, President Biden delivering an address to the nation at 8 p.m. Eastern on the Israel-Hamas war, as well as Ukraine, following his brief trip to Tel Aviv. UK Prime Minister Rishi Sunak now visiting Israel in the latest effort to prevent the conflict from widening. Sunak is meeting with Israeli Prime Minister Benjamin Netanyahu today before heading to other regional capitals without specifying which countries exactly. That might be the best approach because, based on the president's experience, those meetings, Bramo, can get cancelled at short notice.
And on the heels of something that still is highly contested, what I think is so interesting is that a lot of the leaders of the U.S. and the UK are trying to go direct to the client, to the constituent, because right now there is an information war that's been going on, and you can feel it in this material way. And everyone's trying to win, and there's disinformation, there's real information, who knows what it is, it's the fog of war. But right now, there is a real question of how do the leaders coalesce a majority to their side amid this dissonance?
I would suggest they're trying to harness the speed of technology and the speed of media here, and what there isn't enough talk about is what is the war development going to be. I thought
Lisa's onto something, Tom. The information war, and not just abroad
I agree.
at
I like
home.
the phrase. Yeah.
The President of the United States has come out and said that his Defense Department has told him that blast at that hospital was the responsibility, his words, of the other side.
And I saw the first
within
map
his
of that.
own party, in his own country. He's got officials in the House going around and saying that Israel was responsible for it. That information war is not a foreign concept. Lisa, that's happening domestically.
And you can say what you will. There are a lot of independent examiners who are coming to the same conclusion. Ian Bremmer, I just want to say, of Eurasia Group, put this out on the platform formerly known as Twitter, saying the level of disinformation on the Israel-Hamas war being algorithmically promoted on Twitter is unlike anything I've ever been exposed to in my career as a political scientist. It's not just Twitter, it's across the board. This, to me, is one of the key questions as we head into the next phase. How do you get control of the message that's been disseminated in a very different way?
It's been pushed out by sitting members of the House of Representatives.
Correct.
Is that not a problem for this president of the United States?
It's
Doesn't he just sit some of these- of his own party?
fractious party
in Congress?
Yes.
That's shocking, Tom. I'm surprised it's not headline news in this country.
Well, I think it is.
And even after the Defense Department came out and put it, it was still just lingering there on
It's
Twitter.
headline news, including the protests
is.
that are going on in the rotunda of the Capitol yesterday and I believe today as well. So I do think it's news, but it's buried in the diplomacy, the visibility of
Well, the House is a mess, so let's go through it. The House of Representatives expecting to hold a third vote for Speaker
I didn't
later
know that.
today.
Really?
Congressman Jim Jordan failing to get 22 votes from his own Republican Party yesterday after coming up short initially on Tuesday. He can lose no more than 4 votes as long as Democrats remain united. The post has been open for 2 weeks now. It's been 2 weeks. Feels longer, doesn't it, Lisa? But it's only been 2 weeks when Congressman Kevin McCarthy was pushed out.
Honestly, to me, I'm just looking at this. Why would he want to go up again for a third time? He's losing votes. He lost 2 Republican yes votes, and they changed it to no votes.
Getting worse.
It's getting worse. It's not getting better. So why go up again? Why deal with this humiliation? I don't understand that.
To be accurate there, I believe it was 2 voting for him and 4 voting against him. So that was the negative 2.
It's dysfunctional. It's messy.
He has a jacket like you.
Does he?
Yeah, it's like the Ferro look.
What does that mean?
It's like a blue thing, and it's cut and chiseled because he's a wrestler.
That's the
like
look.
you. Yeah, it's like you.
Cut and chiseled and it's blue.
Yeah,
okay.
It's a Ferro look.
Let's get to US housing. Mortgage applications in the US hitting a near 3-decade low. And this is part of the reason. The average national fixed 30-year mortgage has hit 8%, according to bankrate.com. Tom, you've got to go all the way back to the early 2000s for anything that looked like this.
The way you do this at home is you figure out how much house can you buy, and here's the operative word: less.
So true.
You know, that's all there's doing. The conversation right now is so important, including the conversation David Weston will have with the chairman here in the noonish hour, a fireside chat. We are so advantaged. His fancy title is Global FX and Interest Rate Strategist at Macquarie. But what's really important here is Terry Weissman's decades of work at considering the holistic view of interest rates moving. Dr. Weissman joins us this morning. I want to you go so narrow as to say Chinese renminbi has to react along with all of EM, and we are going to see a floating series of fixed currency solutions, which brings up the Great Triangle and is the only solution to all this angst we're talking about is an organized or disorganized currency devaluation.
For the emerging markets, I don't think so. We have seen quite a lot of devaluation in 2022 in a lot of the emerging market currencies. We've seen the Chinese renminbi depreciate this year. I don't think that this is restoring some sort of stability or growth to the market, to the economies globally. If you're asking me, is the increase in U.S. yields going to put more pressure on the emerging market currencies? I think it will. But the transmission mechanism there is actually quite simple. It's very difficult to want to hold any assets that are yieldy assets abroad when you can earn as much as you can in U.S. fixed income. And I think this is the underlying pressure that emerging market currencies are facing now, including, by the way, the Chinese renminbi.
There's a difficult sort of evil, vicious circle that people are getting concerned about, that as some of the developing market currencies depreciate, the governments liquidate more of their holdings, which are U.S. treasuries, to then go and support their currency. I'm thinking of China, I'm thinking of Japan, not necessarily a developing market, but still. There is a question about whether that just pushes yields that much higher in the U.S. How much is this becoming a sort of self-fulfilling cycle?
No, it certainly can. I think, though, that the countries that are going to be doing this the most are the ones that are concerned about inflation in their countries. But you have to keep in mind that China and Japan are not really inflationary economies at this point. So I think we're really limited to those countries that are inflationary, that want to stabilize their currencies in the face of what's happening with U.S. yields. I don't necessarily see China, for example, waking up one day and saying that the renminbi is too cheap at these levels. And we certainly haven't heard that from the Japanese either. So those are not really the countries we should be pointing to when we're looking at that situation.
From a broader perspective, you said that these higher yields are pressuring a lot of the developing world pretty substantially. And I'm just wondering at what point things start breaking, right? We've been asking that. At what point do things start getting a little unruly in the rest of the world?
I don't think we're close to that in the currency world, right? Look, for example, at South America that I'm very familiar with. You have seen the Mexican peso depreciate in the last few weeks. But but remember, the Mexican peso had appreciated quite a lot in the 12 months previous to the depreciation we've seen. Same thing with the Brazilian real, same thing with the Colombian peso, same thing with a lot of the other emerging market currencies. So we're only at the point now where we're seeing the dollar against these emerging market currencies rise, but off of a very low base for the dollar in view of how much appreciation we had seen in some of these countries. Now, I'm not saying that appreciation came without any cost, right? The way that the emerging markets managed to get their currencies to appreciate last year, those that did, was with very high interest rates, very high real interest rates. Effectively, the situation is that is the problem, right? That is what is slowing those economies right now. Not the currency volatility so much as the fact that a lot of these countries still have very high real interest rates. They're still grappling with inflation issues.
I look at them, and it's still this from Game of Thrones, which is pointier in the math of it, the stochastic. If I look at even, say, Singapore dollar, you know what? This gets solved. They weaken. And they get pointy, just like in Game of Thrones, and they come in. We get pointy, and things get fixed. I'm going to assume they always get fixed by the United States. So when we get pointy in EM, in your world, if we get pointy, even in developing market like yen, I'm going to pontificate out to 153, 154. What does America do to bring in those excesses?
Well, first of all, if some of these emerging market currencies, including the renminbi, started to depreciate more, I think policymakers in the U.S. would not mind at all. Keep in mind, that would be disinflationary for the U.S. economy. It would provide or produce more flexibility on the part of the Fed to be able, if it wanted to move away from this tightening policy narrative that we've seen over the last few months. I think from the perspective of Americans who are concerned about inflation, and maybe this is the reason why consumer sentiment is so poor in this country, you actually want to see some currency depreciation in the valuation abroad.
Let's wrap it up. Chairman Powell, what do you want to see later?
Oh, I don't think that he's going to step out of line here. I think the narrative has been about high for long. I think you have seen some regional Fed presidents who happen to be on the other side of the spectrum increasingly vocal about the need to not raise rates anymore. But please do not read this as a signal that there should be more flexibility about the medium and long-term outlook, which is currently defined as high for long. That is going to stick. He'll probably repeat that. And even if they are on hold on November 1st at the meeting, high for long will still be an important part of the narrative. We are not anywhere close in terms of dynamic and the dynamism of the U.S. economy to make it a reasonable expectation for them to take that away anytime soon.
Is November a live meeting?
I think so.
Okay.
I do. But I think that in view of how many of the regional presidents and those board governors that have been vocal about keeping things on hold, I think we're going to look at an on-hold situation in November 1st.
Terry Wiseman of Macquarie. Terry, good to see you.
Pleasure.
Thank you. Looking ahead to noon Eastern, Chairman Powell sitting down with Bloomberg's David Westin at the Economic Club in New York. Look out for that a little bit later live on Bloomberg TV and Radio. If you are just joining the program, welcome. Your S&P 500 negative by 0.1%. Coming up a little bit later, Claudia Sahm of Sahm Consulting reacting to jobless claims data about 45 minutes away. The claims data, Tom, still in and around 200K.
It's been underspoken, and there it is. We're going to see that in less than 1 hour in the claims. And there's a whole bunch of theories. John Hatzius with a smart note with his team there about how claims are artificially suppressed right now. But Claudia Sahm heated on the nominal GDP and real GDP optimism that Justin Wolfers was talking about the other day on this boom economy. We had someone say 5% for Q3, which is shocking.
Did you see, though, yesterday's data that came out with how much the balance sheet of the American consumer increased over a 3-year period, a record amount in data going back to the 1980s? People have just been stockpiling so much more cash than anyone had imagined, and that seems to be fueling something. Everyone's been asking, when does it run out? It doesn't run out if jobless claims don't go up and if people are getting paid more. And that, I think, is the distinction that's causing a lot of people to change their view.
More than we realized.
Yes.
More than we realized.
To tie it into the Bloomberg poll, I'm sorry, it's two Americas, and there's this massive polarity here. And some of that polarity is engendered by a financial market on the move.
We need to talk about the airlines. American Airlines out a little bit earlier this morning, cutting the outlook. It's a tough time for the airlines. Jet fuel prices moving in the wrong direction for them through the summer. On top of that, maybe a softening of demand domestically, flagged by some of the domestic-focused carriers, Tom. I'm thinking JetBlue, Southwest over the past few months.
Totally agree, but every seat's taken. That's the difference this time. Every seat is full. Why
Which
are they
part
struggling?
of the plane were you sitting on? Did you turn around and look at the back?
I look back. My people were back there, and
Were they? Oh, the entourage in the back.
Oh, dear Lord.
Okay, Brooke Sutherland, Bloomberg Opinion on the airlines, next.
Anytime you see rising economic and geopolitical uncertainty, which is what we're seeing now, that is bad for markets. It saps investor confidence, it saps company confidence, and we're just bad at pricing it. These high levels of uncertainty have unfortunately become a new normal.
Tell you what else is the new normal, and thank you, Ben Laidler over at eToro. These moves in this bond market is the new normal. Just big moves in either direction. We saw it again yesterday, see it again this morning. Let's check out the bond market now. 10-year yield, really close to 5%. Keep one eye on that all morning. 497.91.
Wow.
Up by 6 basis points. On a 30-year, up by 7. 5.06%. On a 2-year, up by 3. 5.25 on a front end of the curve. This bond market, Tom, it's been amazing to follow over the last few months.
With all the news flow, and particularly what Oliver Crook and Anne-Marie Horton are viewing in Israel, we forget that this is really a bond market on a move. And it's, John, across every single indicator, the disinversion, we were at what? A pre-Misra negative 100 basis points, and we've gone negative 100 to negative 27. Can I dare say begin to model where the 2-year and the 10-year are the same yield? Am I there yet? I don't.
Tom, I'm with you. I'm following the same
yet.
thing. That curve steepening we've seen that's come from the long end, the jargon you'll hear from the bond investors, the bear steepener, the best argument I've heard for it, and this really is the best argument I've heard for it, comes from Steve Major and others as well. When you're in an expansion, not a downturn, and you are asking investors to go out along the curve and finance the government for less yield on a longer maturity in an expansion, you're going to get pushback. And arguably, Bremo, I know it's only one piece of the story because there are many in this puzzle, but that piece of the story is really, really important. How do you convince someone to go out on the curve, pick up a 10-year for less yield than a 2-year? When you're in an expansion, you see retail sales data like the data we saw this week, saw payrolls like we saw a few Fridays ago, so CPI and PPI still coming in a little bit hot. It's hard, which is why you're seeing this curve re-steepen.
Another way maybe of framing this is that the bond market is essentially saying what the polls are saying, which is recession is no longer the base case. And if that's the case, things get more expensive from here and inflation may not come down the way that people thought that it would. And people are losing the sense that the Fed has the conviction to do the heavy lifting necessary to inflict the pain required to get inflation under control.
Now, the question is, this is in an expansion. If things get bad, do people start to buy the bonds? That's the question. Typically, they do. And I will stress that's one piece of a much broader puzzle in this market right now. You can throw in China, you can throw in the deficit, you can throw in yield curve control and the BOJ backing away from that, QT, the ECB, all of the above. There's a lot going on in this bond market. I want to finish on American Airlines. Look at the stock right now. They've had to cut their outlook. The stock's still doing okay. The stock's been battered, though, over the last few months. Peaked back in the summer for many of these airline stocks back in July. New outlook, Tom. Adjusted EPS, $2.25 to $2.50. Previous outlook, $3 to $3.75. The estimate, $2.34. This is about higher fuel costs, Tom. It's about softer demand domestically as well.
The complexities here, we're going to get to it in a moment. But, John, the way I look at this with all these airlines is I compare the price now to the COVID gloom. And American Airlines is just under $10 per share. So they're a little bit off the COVID gloom, I guess is how I would put it. This is a joy. Brooke Sutherland joins us now from Bloomberg Opinion, and far more importantly, a girl from Kansas, holding court at the Lawrence Journal World a few years ago, and everyone knows Kansas is glued to the heritage of American aviation. Brooke, Robert Crandall of American Airlines a few years ago changed our world. His arch theme was put fannies in the seats. We did. We went from capacity of 70 whatever percent up to, some would say, 102%. Why are the airlines struggling so bad if every seat's taken?
Well, I don't know that it is, and they're having to go to some great lengths to fill some of those seats, especially in the fall, particularly among the more domestic-focused carriers. JetBlue, Spirit, Frontier have all been running fare sales to try to stimulate demand to fill those seats. And part of the issue, to your point, is they have been aggressively adding capacity. We had that period post-pandemic where demand came roaring back and the airlines did not have the seats, did not have the infrastructure to meet all that demand. The natural response was to add more capacity, but now we're sort of on the other end of that revenge travel boom. It's not as strong as it was. We still haven't seen business travel come back, and the airlines have too much capacity domestically right now.
Okay, there they are. And I've seen the economy flights. The one I look at is New York to LAX, and maybe it's $700 in the boom down to $300. Do they have any ability to cut costs? I don't see it.
It's very difficult because their fuel costs have risen significantly. Their labor costs have jumped. Many of the airlines have recently signed new labor deals with a number of their unions. These are at very high price points. And there's always a natural lag in the airline's ability to pass those higher costs on to customers. But of course, that gets much more complicated if you are simultaneously running discounts to try to fill your seats. The ability to close that margin gap is a lot tougher.
How deep do the discounts go, Brooke? And I'm not asking as someone interested in travel. I'm asking for someone who is wondering how much of the price increases that have been dramatic over the past 3 years are going to stick longer term.
Sure. I mean, it is a bit difficult to get a good read on where airline pricing is. We have that CPI basket, but that does tend to be more heavily weighted to lower discount fares. That would seem to indicate that prices are actually down. Of course, that does not feel like they're down significantly if you are a person that is buying flights right now. But there is a moderation here. I mean, this is a consumer-facing product. I just don't think the pricing is ever going to be as sticky as what you might see, certainly on the aircraft manufacturing side or any kind of air manufacturing business. Those tend to be a lot stickier. Those are a lot harder to trim down. There's a saying among a lot of industrial analysts that prices just don't come down on the manufacturing side, which of course creates another pressure point for some of these airlines who do need to buy aircraft in order to renew their fleet.
Which is the reason why there's been this focus on maybe reducing capacity by the big airlines and just charging more. So basically just catering to the people who have to fly and are going to have to pay the higher fees. How much does that become the model, given how high the fixed costs, as you explained, have become across the board?
So we haven't seen a lot of big capacity cuts yet. No one has blinked yet. I wonder, at what point that might be coming. And I think, as fall goes on, if we don't see business travel materially come back, which personally I don't expect it to, I think, this is a very easy bucket of costs to cut. Pre-pandemic and especially post-pandemic, as we proved that we could do things virtually, it's a just much easier bucket to target when times get tough at companies. And so I think if you don't see that business travel market really bounce back, some of the airlines are going to have to take a hard look at their scheduling and think about if that really makes sense.
Brooke, in the Airbus-Boeing war, my amateur take is Airbus is winning. How bad is Boeing losing?
I think that is a very good take on what's happening in the market. That Airbus has, I believe, about a 60% share of that narrow body market, which is really the workhorse for a lot of these airlines. Look, I mean, Boeing has bounced back from the crisis. I don't think it's in anybody's interest to have a situation where we move from a duopoly in aircraft manufacturing to a monopoly where everybody just buys from Airbus. The waiting lists are very long for all of these planes. I think Boeing is holding its own. I think the question is, when you look out, in the out years, does Boeing need to invest in some sort of product that would target that sort of middle spot between the narrow body and the wide body? Airbus is developing its extra long range version of the A320. That's not a market that Boeing can fill at this time, and they need to figure out what they're going to do about that.
I don't think we want a monopoly in anything, but Brooke, just on the prospect for consolidation, can we go back to the airlines? What does that look like now?
Well, we're still waiting to see what exactly is going to happen with JetBlue's bid to acquire Spirit. The DOJ did sue to block that deal. That will be sorted out over the coming months. Personally, I think it's a little bit of a tough argument. If you remember in the railroads, that's also a very highly consolidated industry, and we just had a very significant deal there with Canadian Pacific acquiring Kansas City Southern. That shrunk the railroad market to the same degree that this deal would shrink the airline market. And I think it's a tricky argument to say that, allowing these two smaller carriers to combine won't create actually more competition. If you look at just how dominant Delta, United, American are, there is an argument to be made that allowing JetBlue to get stronger actually creates more options for customers. Now, the DOJ doesn't see it that way, but we'll see what happens as this gets sorted out.
Hey, Brooke, thank you. Brooke Sutherland there on the latest. My experience in America, talk a lot about competition. Depends where you want to go. Ultimately, if you want to go to one place, how much competition is there? What we've got is that basically Delta will own one part of the world, United owns the other part, America owns the other part.
JetBlue owns another part.
We're talking about competition.
Yeah.
What competition is there?
I think that's a great point.
To me, it's a little bit better than it used to be, but you're absolutely dead on. I'm amazed how quickly the market's moving. LAX, I look at 2 flights, $700 down to 3 something, and I look at a Paris flight, business class, John, $16,000.
Of course, yeah.
And it's now $5,000. I mean, I did not realize how, like Brooke said, how the prices have come down.
That's quite a headline, TK. It's quite a headline.
That is. Look at that. It's
Nothing
cheap.
personal about that, is there? Nothing at all. Coming up, Mark Esper, the former Defense Secretary.
The Fed is going to try to be quite patient, especially with real yields where they are.
It's the speed of the move that matters, and we've had a pretty aggressive move in treasuries.
So far as central banks are concerned, the rising bond yields that we've seen is doing some of their work for them.
Is the long end doing some of the Fed's work for them? Absolutely, but that's proving not to be enough.
We've entered a far more complicated phase of this cycle.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene on television, on radio. It's the Fixed Income Report. We're doing that for Chairman Powell, 12 noon, David Weston. See that across all of Bloomberg. John Ferro, here's the numbers. This is it's like bingo or whatever at 11 p.m.
Go for it.
525, 498, and 506. Those are Powell's winning 3 numbers today.
Or losing, depending on how you're framing it. 2-year, 10-year, 30-year cycle highs in this bond market right now. Yields, let's frame it in simple terms. 3.30 in the spring of this year, 3.3% after the banking tension in this country and seemingly cycle over. Here we are almost 170 basis points later higher, Tom, and still climbing this morning. The question for the chairman later on this afternoon, is that move a substitute for further action from this Federal Reserve if this economic data keeps surprising to the upside? And it has. CPI, PPI, retail sales coming in hotter than expected.
The bow tie word is unanchored. I don't know if they're unanchored, but I know in the last 48 hours, people are worried, to say the least, John. I mean, it's just, there's an angst here in the last 48 hours, yes, because of what we see in the Eastern Mediterranean, but separate from that, there's a new bond angst.
I don't hear that angst on the Federal Reserve yet. What I hear is that we can wait. Governor Waller used that phrase yesterday of the Federal Reserve, we can wait. And I think they want to wait for 2 things. They still don't really understand, from what I've heard, what's going on in the bond market.
Right.
Kashkari was perplexed. I still think they're surprised by the nature of the economic data coming in as hot as it has done as well. If you take Morgan Stanley's Ellen Zentner, she's looking for that slowdown in 4Q, acknowledging that the data's hot coming into the last quarter of the year, but still pushing the idea we get that slowdown in the economy. So if you're the Federal Reserve, do you want to pull the trigger in November? Or do you want to get another dose of data and wait until December? Which is why a lot of people have still got December highlighted and November just pulling back on the idea they do anything soon. And Tom, that can change with the chairman. It's up to him. He's going to get the last big word going into the quiet period. That can change with the chairman and David Weston later on this afternoon.
Maybe over lunch, it's first thing to do harm. Bramwell with the toughest job on the desk, trying to keep track of the Fed speakers along with bond market. Wisdom, it's just absurd. We have like 4, 5, 6 every
7.
day.
Well, today we've got 7, yes. We've got, do you want me to do the whole thing?
Please.
Fed Vice Chair Philip Jefferson, Chicago Fed President Oscar Goolsbee, Fed Vice Chair for Supervision Michael Barr, Atlanta Fed President Raphael Bostic, Philly Fed President Patrick Harker, Dallas Fed President Lori Logan, and then, of course, Fed Chair Jay Powell.
From another era, though, before Arthur Burns, I'm going to go to the economist William Joel. That's how silly all this is. His great song, We Didn't Start the Fire, and it begins with the economists and speakers, including Truman and Jolton Joe DeMont, Doris Day, Walter Winchell. I mean, that's from another time and place. But to both of you, John, let me start with you. Is this too much communication?
Yeah. It's the simple answer to that. But ultimately,
England does this better.
In what way? They speak less?
They speak less.
Well, there's fewer of them, so that helps. There's certainly fewer of them. We're talking about a 9-person MPC versus what on the Federal Reserve?
Right. We're going to do this.
Can I just say one thing?
Please, please, please.
If they have something to say, great, speak. If you don't have something to say, does it muddy the waters at a time where it's very difficult to say something?
Yeah. Some of these are scheduled so far in advance.
Right.
So I have some sympathy for them. But ultimately, there are key figures you need to listen to more than others. Chairman Powell's going to set the tone today.
Yeah.
What he says goes going into the quiet period.
I want to sum up off something yesterday in John's observation on the United Kingdom and 6.7% inflation. And John, I said the duration of it is really something. It's a chart I've never seen. Ben Bernanke would call this a hockey stick. But the answer is, if you look at UK inflation on a steady trend, John, back 20 years and something changed 3 years ago, and it's the sum of that inflation move, up 27%, and it rounds out perfectly to 10% per year in the United Kingdom over 3 years, over 3 years.
I saw you looking at RPI, which was kind of de-emphasized in the early 2000s, and CPI was sort of where the emphasis is now. Yeah, but same trend, same story, Tom. Inflation's a problem.
I just took it because it has TOTS tickets in it. But that's the emotion that we've got here. And look for Chairman Powell today with David Weston. Let's do the data here. And we already did it, but let's do it. I'm going to go to Brent crude 93, down under $91 a barrel, John.
Straight to the bond market, Tom, up 6 basis points. 497.27. The high of the session, just briefly a moment ago, 498.13. We are so close to 5% on a 10-year, Tom. This is not where people thought we'd be coming into the fourth quarter. They were looking for disappointing data. I heard calls like 350 on a 10-year, maybe even 3%. TK, look at where we are.
Yeah.
Up near 5% on a 10-year, through it on 30s, and at 526 on a 2-year. Remarkable stuff.
The bank rate 30-year mortgage, 8% even. And now the most important conversation of the day for people south in bonds, worried in equities. Brent Schutte is Chief Investment Officer for Northwestern Mutual Wealth Management. He speaks to people who are scared. What is the emotion of the bond investors? Either they're in bonds, they're in 60-40. Brent, what's the emotion of the people with bond losses right now?
Well, I think people haven't seen these for quite some time now, and I think they're very worried and very nervous. To me, look, bonds now yield something. They offer real value. I don't know where the ultimate end to this is. I don't know that we don't go higher, but I think anyone buying treasuries today at 5% with a real yield of 2.5 plus is going to be happy in the next few years. And so to me, bonds for the first time in many years offer value, and investors should be buying them, not selling them today.
Brent, where on the curve?
Well, I think that ultimately I heard Tom's conversation about the Beloit, Wisconsin individual, and that happens to be in my backyard. I hope that no retiree is funding their near-term liabilities with longer-term assets. That, to me, is not just something that banks shouldn't do. It's also something individuals shouldn't do. And so I think it depends upon that. So what is your income stream that you need? But to me, I don't want investors to set in the front end of the curve, because who knows where interest rates will be in 2, 3, 5, and 10 years. Think about your comments opening up about 3.3% and people expecting it to go lower. Look, I think people who invest only in the front end of the curve forget about reinvestment risk. And to me right now at 5% in the 10-year, I think that's an attractive area for people to begin thinking about.
And Brent, typically when a client would come to you and you talk about balance and diversification and that old 60-40, has that balance and diversification idea shifted given what's on offer now in the bond market?
I think it has. I mean, if you think about the last 10 years, equities have done the heavy lifting. Bonds basically weren't much of a help to the overall return. It didn't mean that you shouldn't have them. It just meant that they didn't offer much in the way of returns. They certainly funded some near-term liabilities. But to me now, bonds at 5% yields, I mean, the Bloomberg aggregate, your own index, yields 5.7%. Typically what you buy a bond at, especially if it's higher quality, is what you get. And so to me, over the next 5, 10 years, a 60-40 probably looks a little bit better, and the bond side is doing more of the carrying.
Brent, you talked about reinvestment risk, and people have been talking about this all year, even as the best returns in the fixed income space globally have come from cash. At what point is cash better than people want it to be? Because ultimately, if you take the Fed at their word that they're going to keep rates higher for longer, this is going to be the most secure investment that potentially you could make.
Look, I think the Fed keeps rate higher for longer until they get a recession. And I'm not for sure how far we are off from that. To me, the Fed has the resolve. They do not want to repeat 66 to 82, which is what Powell mentioned in his last press conference, where he talked about letting inflation kind of keep going, which was wage inflation, which caused the Fed to have to keep coming back in and over and over and created a miserable period. They don't want that to happen. To me, wage growth is still too high. The labor market's too tight, and the Fed isn't going to stop until they get wage growth lower, which to me means a recession. And so I think that's on the horizon. And when that's on the horizon, I think you want to own securities that are just a bit longer than cash, because there certainly will be some, pullback in the shorter term yields.
At this point, though, that's actually counter consensus. That's actually pushing against the grain, where people are really writing a recession off the table in the next couple of years. How much confidence do you have in this? How aggressively are you legging into the long end of the curve? Are you buying 10-year treasuries?
I'm happy to be against the contrarian person again. I mean, I was the person last year who liked equities when everybody else thought the recession was coming, and I thought inflation would come down because it was tied to COVID. And if you look now, all-in CPI and core CPI less shelter is at 2%. Look, I feel very comfortable that we are near the end of an economic cycle. I don't know, nor does anyone, when exactly the recession will occur. But at the end of an economic cycle, you want to behave just a bit better. And that's where I think buying longer-term or intermediate-term bonds offers some protection against downside again in equity markets.
Brennan, a Sharpe ratio, do you have any idea where the risk-free rate is? We didn't know where it was for 10 years, 12 years, 14 years, and OMG, we can actually measure the puppy. No, we can't. Do you have a clue where the risk-free rate is?
I think it's probably higher than what it was. I don't think 2014 to 2020 was anything normal. I don't think it was the new normal. I think you're actually back to something more normal historically, which is a real rate that's higher than what it was, because you now have consumers who have rebuilt their cash coffers. You now have companies who have done the same. I mean, the world's awash still in liquidity, which is retracting. I think rates are likely to be higher. And I'll add one more point. I mean, real buyers demand real yield. For years, central banks were the buyers, and they didn't care about real yield. And so you're kind of seeing the hands change in the bond market, which I think all this is perfectly rational. So I guess in a long-winded way, I think the real yield is higher. I think that 2.5% real neutral rate the Fed keeps penciling in has to go up. And so I think it's probably higher, but it's certainly not where we're at today.
Lisa mentioned the work of Dilip Singh over at PGIM regarding that, Brent. Just lost that price-insensitive buyer. Lost that predictable source of demand with the Fed and other central banks backing away. Brent, I want to finish on this, and it warrants a much longer conversation, and we can do it again in the future as well. The events of the last few years and the policy response to them have arguably screwed up this mortgage market, this housing market, potentially for a generation. And Brent, as you know, for a lot of people, the biggest asset they have is their house. Now a whole generation faces the prospect of not having that. Brent, what does that mean for how investment is going to change for them in the years to come if that frozen housing market doesn't unfreeze, doesn't melt?
Yeah, I mean, this is where you keep mentioning the 8% mortgage yield, and that's something that is in today. To contemplate that the effective mortgage rate in the U.S. economy is 3.6%. That's why the housing market is frozen. I think it only unfreezes when one of two things happens, or probably all of them. Prices come down a bit more, or rates come down, which I think will eventually occur as you get that recession. I think you'll see a pullback in mortgage rates, which will hopefully unfreeze the existing homes market. Certainly the new home market has been a place that you can actually see some unfreezing, but it's probably, the housing market is probably not going to continue its ascent that it's had over the past few years and decades.
Hey, Brent, thank you, sir. Brent Schutte there on the latest in this market and the housing market as well, just messy. If you're just joining us, welcome to the programme on the S&P 500. We are negative here by 0.1%. Yields are higher by 6 basis points on a 10-year, 4.9727. You can track the effective mortgage rate on the Bloomberg terminal. If you would like to do that, USMIRATE. The current effective rate on the outstanding pool of mortgage debt is 3.6%. Do you know what the low was? Spring 22, 3.3%. Amazing, Tom, how low that was. Climbing, and it's going to take a long time to climb as well, because a lot of this is 30-year stuff. 30-year stuff, Tom.
Particularly like Bramo, where you're putting 2% down. I mean, you get a pop off that mortgage.
Bramo likes to brag in the commercial breaks about the two-handle on. I know.
Not the two-handle on my down payment. The two-handle on the mortgage.
Bramo, don't worry. No one's confused.
But he was
Everyone's
saying,
got faith in your ability
down.
to invest. Don't worry.
I'm one of the high FICO score people.
It's Lisa Abramowicz. Let's get this mortgage done.
Bragging rights in 2023 is not a Lamborghini, TK.
No.
It's a 2 or 3 handle on your mortgage.
100%.
We get notes in here like crazy. And thank you, Stuart Kaiser, for an options note from Citigroup. John, a week from now, the tech frenzy starts, maybe with Netflix, but, Microsoft, the 24th, Apple. And Citigroup's modeling out, hey, stupid, buy call options. I want to make clear, this is a speculation. This is not investment. But Stuart Kaiser, constructive on the market, has a note, a tech call option speculation.
That's to capture the upside in tech. Apple, Tom, November 2nd, day after the Federal Reserve decision. So just around the corner. My favourite part of earnings season. 2 reasons. Prefer to hear from the tech names, 1. 2, they deliver them after the bout. So you get to sit there.
It's great.
Watch our colleagues just take it in and
choice,
read the documents. That's always good. From New York, this is Bloomberg.
Today, the Economic Club of New York hosts a conversation between Fed Chair Jay Powell and Bloomberg Wall Street Week's David Weston. Recession risk, inflation outlook, real estate amid high rates, and more. The live interview happens today at 12 p.m. Eastern on Bloomberg. Context changes everything.
The president and a number of his advisors firmly believe that the post-9/11 years drew the United States into a dark place. I think part of the president's trip to Israel and his work tonight during the speech will be to shape the U.S. domestic audience, where we've seen a number of protests, to include anti-Israeli protests in the U.S. Capitol yesterday.
That was the brilliant Norman Rule there, the former senior U.S. intelligence official on the latest on the ground in Israel and across Gaza. From New York City this morning, good morning and welcome to the programme. Just to touch base on what's happening in the price action right now on the S&P. S&P 500 futures slightly negative, down 0.1% on the S&P. Yields a little bit higher by 5 basis points on a 10-year, Tom. 496.84 earlier on, very close to 5% at 498.13.
We're watching the bond market very closely here, and of course we'll go off the economic data here in about 12 minutes. We've underplayed it today, but nevertheless claims is important. Oliver Crook is in Tel Aviv, and he is reporting there on military efforts to come. We made a decision at Surveillance that we would really focus on people with tangible, active skills. We had Elliot Ackerman on the other day, former Marine, I believe, 1st Battalion of years ago with any number of tours of duty. Admiral Stavridis joined us the other day, and now Mark Esper joins us. He's got a big fancy title, forget about it. He's a Screaming Eagle of the 101st Airborne with on-the-ground experience. He is the former U.S. Secretary of Defense. John?
Mark Esper, I'm pleased to say, joins us around now. Secretary Esper, fantastic to catch up with you, sir, as always. I wanted to lean on your experience in the administration. We've seen some landmark accords come out of the Trump administration, the Abraham Accords, just establishing diplomatic relations between Israel and places we never thought we would. We were hopeful that was going to take place with Saudi Arabia and Israel. It hasn't. Mark, are we learning that there are some forces in the Middle East that just don't want peace?
Yes, of course we do. And that is Iran, principally. And then there are the proxy groups around the region that they support, Hamas, Hezbollah, the Houthis, the Shia militia groups in Iraq. Look, I think a big part of what motivated Hamas to attack at this time and the way they did was the fact that the normalization accord between the Saudis and Israelis was moving forward, albeit slowly, but moving forward. And of course, if it was concluded on the terms that we knew that were leaking out, that would have meant a tremendous shift of power back to the Palestinian Authority, which, of course, we know the Hamas is opposed to, right? There's friction between Fatah and Hamas. And of course, the Hamas's benefactors, Iran, would also be hurt by normalization, because you'd finally see an alignment or an emerging alignment between the Arab states and Israel against Persia, against Iran. So I think those are principal reasons why this attack happened at this time.
The political battle will be engaged, the look back, the 2020 hindsight, Secretary. What I'm fascinated by is how we prosecute a military affair with Israeli forces, okay, fine, against terrorist groups. We've never really done this, have we?
Well, I mean, you could argue that our response after 9/11, when we went into Afghanistan first to displace the Taliban, and then, of course, the pursuit of Al-Qaeda and eventually ISIS, et cetera, was part of that. We, of course, yes, we went after ISIS in Syria as well. So, but I get your point. Look, it's very tough. You have an army built for big, heavy conventional fights, an extraordinary soft capability, going into a heavily populated, dense area, trying to root out militants among the public and having to fight in multiple dimensions, right? On the ground, above the ground, and below the ground. And it's going to be quite a bloody and messy affair.
What would the Screaming Eagles do? I mean, you've got tangible experience here. Do they do a massive bombardment a la World War II, say, and then go in? or do you expect them to prosecute something different?
Look, I think we've seen the bombardment so far. At some point, they're going to have to move in and go street by street, block by block. I think part of the reason why you see so many airstrikes is they're rubbling buildings. I will tell you, you refer back to my time with the 101st Airborne. When we were in southern Iraq at the Gulf War, we wanted to avoid cities because city fighting is really tough. It consumes a lot of soldiers, not just those you lose, but you have to leave people behind. And again, when you're fighting in multiple dimensions, this is really tough. So I think they go block by block, being very careful to avoid civilian casualties. At some point, they occupy. But the really big question that we don't know yet is what's the end state? What happens when they're done? Because at some point, they're going to pull out. They want to pull out. And what vacuum do you create? Do you somehow politically get the Palestinian Authority to come in? Is there some type of inter-Arab peacekeeping group that comes in? Those are the big unanswered questions. What does the end state look like?
Secretary, you were defense secretary under the former President Trump. How would have his response been different to what we're seeing today?
I'm not sure that it would be different in this moment. I would argue that it would be different with regard to Ukraine and other countries. But with Israel, given the close connections between our countries, our peoples, so much that's shared between our two countries, I'm not sure it would be that much different. Although I would say that I think Trump would probably take a harder line and a more public line against Iran. I've argued for that in the past. I know Secretary of State Pompeo has. And I would like to see more from the Biden administration about connecting the dots back to Iran, because I think at the end of the day, while Israel can go in and decapitate Hamas and try and suppress them, unless you deal with the country, Iran again, who's funding and training and supporting them, then I think Hamas just crops back up over time.
How do you deal with Iran? I mean, this has been one of the big quagmires for a lot of nations, especially given that people want to avoid, World War III.
Yeah, look, I'm not arguing for strikes on Iran right now, but I do think we should see a consensus emerging first between the Western democracies, United States, Europe, and elsewhere, about really finally tightening down economic sanctions on Iran. You could go after their energy exports, and I know what that does to the energy markets. And then you could talk about further isolation of them. I just don't think we've seen a concerted effort over the past, 5, 6, 7 years, and certainly over the past couple. In fact, some would argue that the administration has been so eager to find a nuclear deal with Iran that we've given them too much. And look, there's a good case to be made for that. But I think we need to recognize that Iran is at the root of all these problems.
Secretary Esper, if we can finish on drawing on your experience, what do you suppose is happening right now? What we're witnessing from the outside looking in is a period of intense diplomacy, a troop build-up, seemingly on the brink of a full ground invasion. What do you suppose is happening right now on the ground? And what do you think you're going to see in the coming weeks and months?
Look, I think from the Israeli side, they're gathering intelligence, they're prepping their forces, they're talking about their battle plans, doing some final training and making sure they know the game plan to go in and how they're going to deal with it. I think that's happening at that level. At the same time, they're reinforcing their northern front with regard to Hezbollah in southern Lebanon. And they also have to keep a presence in the West Bank in case that rises up. I think President Biden's made good moves, moving the carrier strike groups into the Eastern Med. The Marines will soon be following in there as well. But one thing that has been talked about is this. Look, if Hezbollah opens up a front in the north, we're going to get involved. We have to at this point, given what we've said about deterring Hezbollah, Iran, and others. And so if Hezbollah opens up a real front there, I'd see American involvement happening with Tomahawk strikes, maybe airstrikes. But we have to talk about that. And then, as you know, there's the grander chessboard out there with regard to diplomacy. Pleased to see Tony Blinken going around the region. I think it's important that we try and keep that Saudi-Israeli normalization deal on hold, make sure it's not dead. At some point, we're going to resurrect that because, in my view, if Hamas and Iran hates that deal, those are two good reasons to pursue it. And I think it would really change the dynamics of the region.
We've got about a minute left, and we can explore the following. I think it would be beneficial. Is Turkey the missing link here? Where does Turkey stand in all of this?
Turkey stands in every place. I mean, they straddle multiple fences, right? They're criticizing Israel right now. They obviously have a large Muslim population, but they're also active in southern Turkey, northern Iraq, going after our friends and partners there. I mean, they play this game multiple angles. On one hand, they're with us in NATO, but he's supporting Putin in other areas. And of course, what we're not talking about is there's a conflict emerging between Armenia and Azerbaijan, not too far away. So you see the world fracturing here in these different spots at this time, and it all traces its roots back decades in many cases.
I'm with you. Some of these key issues just totally off the radar right now. Mark, appreciate it. Let's catch up again soon. Mark Esper there, the former US Defense Secretary and author of A Sacred Oath. Thank you, sir. TK, the latest.
The 700 pages, a sacred oath, was really controversial. In his short term with President Trump itself was controversial. This guy hugely experienced.
Really, really complex stuff. We'll continue the conversation in the next hour on the market. Priya Misra, JP Morgan, John Bavad, BlackRock, Barry Bannister, Steve Thor, Pierre Ferragut of New Street Research on Tesla. All of that still to come from New York City. This is Bloomberg.
Bloomberg surveillance, Jonathan Ferro, Lisa Abramowicz, and Tom Keene. Mr. Ferro in deep preparation for the 9 o'clock hour as well. Lisa and I here with claims, and we're here with an historic bond market. We've got a really important 7 minutes for you. Claudia Sahm will be on, more than opinionated on what Chairman Powell needs to do, and also opinionated here with 2 seconds to go to the anticipated claims report. It's a terrible number. The job market is falling apart. Michael?
Maybe economists are falling apart, Tom, because the number of claims goes way down, 198,000. That's down from a prior release of 209,000. We'll get the revision for you in just a second. Continuing claims rise just a little bit, 1,734,000 from 1,705,000. So a few more people holding on to their claims, not getting jobs right away, but very few people losing jobs. 211,000 is the prior number. So we go from 211 to 198. Fairly hard to believe under the circumstances. Philadelphia Fed is out, and it is a -9. That's down from or up rather, in the way they look at this, from a -13.5. So a little bit better news there on the Philadelphia Fed. The employment index for the Philly Fed comes in at 4 from -5.7. So the employment outlook improves a little bit in that district. We'll see how that carries over as we get closer to the payrolls report for the month of October. But again, a big surprise today in jobless claims. We have been waiting and waiting and waiting for the auto workers' strike to show up, and it just doesn't.
To see that in the markets churning here. To be quick here with the importance of our guests, up 4 basis points in the 10-year, 4.95%, a little bit of green on the screen in the equity market. Michael McKee, what's your first question to Chairman Powell today?
Well, I think it's kind of a combination of questions. Either is it real rates or your rates that are going to matter going forward? In other words, if real rates keep going up, can you stop raising the Fed funds rate? And also, you want to know if you're going to be higher for longer, how long is longer?
Mike, do you think that Fed Chair Jay Powell is comfortable with the moves that he's been seeing in the market? Do you think that he's going to push back against, in any way, what we're seeing?
I don't think so. I mean, markets go up and down, and they tend to overreact all the time. So, yes, maybe he might think we're a few basis points or so too high on some of these, but he knows that all it would take would be one bad economic headline and they'd go down again somewhat. I think they're comfortable with the overall level of restraint that market rates are putting on the economy.
To sort of put a bow on this, there's a question of whether the Fed is no longer the narrative, or whether they're not driving this ship. It really is the economic data that keeps surprising to the upside, with the latest being jobless claims coming in yet again much below the expectation. Why do people keep underestimating just how strong this economy is, Mike?
Well, that's a good question for any of the economics guests that you have, but I think it's because the models are broken and people really don't understand why the economy is behaving the way it is. But as to the Fed in the driver's seat, if they decide, in the face of the high job gains that we have seen, the low jobless claims, the strong retail sales, strong industrial production, that they're not going to raise rates, then they're still in the driver's seat, because the data would suggest Atlanta Fed says 5.4% growth in the third quarter. The data suggests you should be raising rates if you're afraid of inflation.
That's exactly where I was, Mike. I've got it up here on the Bloomberg screen, 5.411 on that Atlanta GDP now. Michael McKee, thank you so much. In Washington, they have to be kept in separate offices in Washington. Claudia Sahm joins us right now, former Federal Reserve economist, with a blistering note yesterday on America's economic growth. You were channeling Michigan's Justin Wolfers, Claudia, yesterday, and it goes off a 5 handle on GDP. Why is America so miserable if we're popping 4.5%, 5% real GDP, throw on the Claudia Sum inflation? Why are we so miserable with 7% nominal GDP?
That's a tough one, right? There can and there have been in the past disconnects between the kind of numbers that we see about the total economy and what families are telling us about how things are going and where they think things are going. Sometimes families are correct, right? We don't want to discount this, and yet at this point we have gotten just all kinds of readings on what's going on right now, and they look really good. So it's been a real slog since the pandemic began. Inflation has been high, but things are good, especially the labor market.
Torsten Slack writes a brief note today at Apollo, and it sums up the consensus of the Fed. We're returning to 2%. Lagarde said that in Marrakesh. We have to get back to 2%, I believe, to paraphrase. And the Richmond Fed has a model which is a higher R-starred. Is this a Fed that's going to have the facts change when they change, or they change when the facts change?
Yeah. What we've seen so far is inflation is coming down, right? If we had seen it still sticking or going up, then okay, fine, R-star's higher, they got to do more probably. That is not what we've seen. All of these models are based on past historical relationships, and we're writing the playbook here. And the Fed has shown themselves capable of rewriting the playbook. They did that after the Great Recession. So they're going to go where the data takes them, but it's really tough when the typical guideposts just aren't working the way they have.
Claudia, what do you make of the fact that the Beige Book and other anecdotal data really has pointed to a real softening, a slowdown, pain felt among the consumers, and the hard data keeps coming out surprisingly strong again and again and again?
Right. I don't look at the latest numbers that we've seen, particularly that 5% GDP growth that appears we're headed at, and say, oh, things are accelerating, we're going back up to where we are. I think this is a sign that we're bumping around a pretty good place in terms of a sustainable recovery. Obviously, that's not going to be felt by everyone. You can absolutely find people to give very heartbreaking stories about what has happened to them. And yet we do have to look at the totality of data, and it's across the board looking really good. We could keep up a sustainable pace that looks a lot like, if not a little better than where we were before the pandemic.
So do you think that this is becoming problematic for the inflation story, right? I mean, in other words, is this growth incompatible with inflation continuing to go down to 2%? Or are you basically arguing that it doesn't matter if we get back down to 2% and that really needs to be what perhaps Fed Chair Jay Powell talks about today?
We're going back to 2%. The Fed is absolutely capable of getting us there. And they may get a little too antsy, and we get there with a lot of disruption and potentially a recession. I don't question that target. It's as made up as 3% would be. So, there's nothing magical here. We haven't seen signs of this being difficult. Inflation is still chipping away down. It's a different story if we start getting stuck, and then you've got to think harder about what's next.
Claudia Sam with us as well, a good analysis of recession, and Michael McKee with us in Washington as well. To the two of you, I've got one question. Mike, let me start with you. Our audience on radio and television is looking at a mortgage rate of 8%. It's either outright shock or how do we adjust to that as citizens? How do we adjust to that within our daily life? From where you sit, Mike, is the Fed aware that a 30-year mortgage is 8%?
Oh, of course they are. And I've talked to many of them about that, and they do recognize it is a bit of a problem and conundrum because they've raised rates and sort of killed the housing market because they're in a different situation than we have been since I can remember, where their rate increases are so much higher than what people were able to take out mortgages at that nobody wants to sell their houses. The thought seems to be that if they start coming back down, they will get to a level, maybe in the 3s, where mortgage rates will come down to 4 or 5%, and people might start buying again because that won't seem too bad. But that's going to take a while, obviously.
Well, Claudia, bring this over to academics as well. You're writing the next paper at Jackson Hole here on the American housing market. Are we at a point, Lisa and I have talked about this, are we at a point where for elites like you, the housing market doesn't matter?
not just for me, right? There were a lot of people that refinanced or purchased housing when we had a very low interest rate. I mean, the housing market has been very disrupted, both in a really good place and now in a really bad place. Like, this has been a tough cycle, and those who timed it properly, and there were millions of Americans who refinanced their homes, they're in a good place right now. And like you said, it does make it tricky. They don't want to sell. They don't want to let go of that.
Lisa, we're completely colored by this in New York City, which is a completely wacko original housing market. To me, this is the arch. We have to live in our houses. I believe that, like every month it's a mortgage payment or a rent payment. And these numbers to me have a greater effect than anything else we talk about. 8% mortgage filters into everybody's pocketbook.
It affects their mobility and their willingness to move, especially given the fact that it's going to be unaffordable for the vast majority of people to do so. Claudia, I just want to bring that together full circle with this idea of the conundrum that a lot of investors have right now. Are we seeing a world that can manage with 5% rates and keep the growth profile that you're talking about and that we're just seeing today, with claims coming in the lowest since January? Is that what we are witnessing?
It's too soon to tell. But we are absolutely setting up what could be, the really important piece of this would be productivity picks up, right? That we're talking about growth that's not just quarter to quarter, but we can really sustain it at a higher rate.
Right.
Then we can deal with the higher interest rates. There are some glimmers of hope. That's all productivity looks like right now in the data, but that's the path. And then we'd need Chair Powell to have a Greenspan moment and be like, growth has picked up. But we're not there yet. He shouldn't do that today when he does the Q&A.
When we're there, this is great. Claudia Sahm, thank you so much. Michael McKee, thank you so much. And that encapsulates it perfectly, Lisa. We're in shock of a bond market. We have an 8% mortgage rate. I think we're benumbed by what's going on in the Eastern Mediterranean. And the answer is Claudia nails it in that we need to have a Greenspan moment from Chairman Powell and David Weston today.
The problem is, I'm not sure how much control Fed Chair Powell has over the narrative. I'm not sure how much control he wants to have over the narrative. They don't know what's happening exactly in the underlying economy, as none of us do. And the bottom line is that the bond market right now is responding more to the economic data, to potential deficits, to potential structural changes than they are to Fed speakers who really haven't made a major impact on yields with what their comments have been.
And what's important here is, as we talked earlier, the linkage here of our economic discussion with our financial discussion, which frankly affects Americans a lot more. And just in the last 48 hours, finance reigns supreme here. Do we really care what jobless claims are, or do we care about what the 10-year yield does to our auto loan?
They're connected, right? If jobless claims are going down, not going up, if you're seeing a really robust labor market, people can afford to pay for a car, even with higher financing rates.
We're going to dive into this. A data check here. We got green on the screen. Bramo driving the markets higher. Futures up 4. Dow up 4. How odd is that? The VIX under 20. That is critical right now, 19.30. Brent subsides, 93 down to $91 a barrel. The 10-year yield is unspeakable, 4.94%. And the litmus paper for so many pros, Lisa, is where you are excellent, which is the credit market. Did those spreads widen out in the last 48 hours?
A little bit, as you see right now, if you are just joining the program. S&P futures just up by 0.1%. Tom, to answer your question, there is this question about why we're not seeing more stress. And the irony between all of this is that we have a bond market that is the full faith and credit selling off, but companies are doing much better. And that is the consistency. Here's the issue, and I said something, and I want to take it back or modify it a little bit. I said, even if rates are going up, people can pay for it if you have such low jobless claims and if you have such a strong market. Not everybody. And you've been pointing to this, Tom, and I think it's a very important point. There is an entire swath of people who are getting cut out of both financing, of the economy, and of, frankly, being able to have the basic necessities at the same level that they used to.
I'm looking at 2,500 square feet, Lisa. This says Bramo on it. It's clocking in at $10 million on Amsterdam Avenue. I mean, that was something you could have slid into at 3%. What are you going to do at 8% on a $10 million unit?
Well, we heard from Brent Schutte, one of two things need to happen or both need to happen. Prices need to come down, and you need to see rates come down.
Good luck with that.
And the two things go in tandem. You get recession, you can see prices come off, you can see yields go down. But until we get that, how do we get there?
Thanks to Michael McKee and Claudia Sahm on your 8% mortgage, your American housing market. Coming up, we look again at the markets here, trying to get to the open. Joanne Feeney joins us, advisors capital. Stay with us, Bloomberg Surveillance.
We are not detecting any clear signs of financial stress. These numbers are certainly, concerning. We actually think that the system can withstand rates getting to 5.5%. The most important point, of course, is how quickly they're going to get there.
That was Seema Shah, Chief Global Strategist at Principal Asset Management, earlier this morning. Right now, we are seeing a bit of stasis in equities, even as we see anything but in the bond world. And I can just say, to me, Tom, that is one of the big takeaways. The S&P futures, yes we saw risk off, but to me have been relatively immune to what we're seeing with 10-year yields nearing the highest levels going back to 2007.
Jeffrey, you talking about the non-correlations out there, and they are there in spades in the equity market. I mean, is Netflix a Dow component? I can't remember. But the answer is, there's some green on the screen after some red 2 hours ago. Critically to me, I'm watching the VIX, which I know is amateur hour, but that's what I do. And the answer is a number of research notes saying 20 is a key level. We're at 19.25. And that signals, like with the bond market, OMG, we ought to be at a 23 or 25 VIX, and we're not.
Well, and this is because it's the bond market and the questions around why. The strength has been in the equity markets, and the consistency of that we're seeing in some of the earnings. I want to go through a number of names because it is earnings season. American Airlines came out cutting their full year forecast. Normally you'd think, oh my goodness, the sky is falling. They're not able to make up for higher costs with higher fees that they're charging their customers. No. And that's because they downgraded their expectations so much heading into this that their shares are popping more than 3% on the heels of a sort of weaker than expected forecast. It gives you a sense of kind of where we've come from.
I look at American Airlines 40 to 11. It was 40, all the pandemic help, and it's just with all the airlines. It's not just American. It is challenging.
Netflix, I think, is interesting because they're able to increase prices and crack down on password sharing and still see their revenues grow 15% pop. Some of the high flyers seeing pretty big upside if they outperform. I think that's interesting. Las Vegas Sands, people still going on vacation. It sort of goes to this question of when do people run out of discretionary income? Well, not soon enough to stop going to some of the casinos at more than 5%. Tesla, I want to sit on this for a minute. Tesla came out and they really disappointed. What I find most interesting, Tesla has always been a margin story. They have been a story of bigger margins than for a lot of the other auto manufacturers. And those margins are compressing as they cut prices repeatedly to compete with China. To me, I think that is the story to watch as those shares go down more than 6%.
Are they a tech company or are they an auto company? And the report to me was very auto-ish. That's my new word for the day.
All of a sudden, production hell. He started talking about the actual nuts and bolts manufacturing of this.
Manufacturing a car. In my study of big three autos over a Mario Gabelli lifetime, is it's a single-digit business. Is Elon Musk ready to do a single-digit business? No.
Maybe he can go to Detroit and get some advice over there, where I hear that they're still, full of time and no problems whatsoever. Joining us now to talk, particularly with a focus on earnings that we have perhaps neglected more than we should have, given all of what's been transpiring in the Middle East, is Joanne Feeney, portfolio manager and partner at Advisors Capital Management. Joanne, what do you make of the fact that even disappointments aren't being punished all that much, that the bar has been so lowered, and that early signs show that companies are stepping over it during this earnings period?
Lisa, I think it's might be a pause this time around, giving companies a little bit of leeway here as we head through the end of this year. I think the worries are going to come for next year. So, the expectations starting the year were so dismal. We're going to end up in a recession and margins were going to compress. What we've seen is companies actually being able to work through some of the inventory problems they started the year with. And then in this back half of the year, turning in some pretty decent numbers. Heading into the holiday season, we're seeing Amazon hire more than we would have expected. And the consumer is holding up pretty well. And look at that labor market. More people are getting jobs and fewer people are getting fired.
What do you do index versus active? I mean, I got an actively managed portfolio of 7 stocks is sort of where we are at right now. How do you tilt on spread it out versus concentration in sectors?
yeah, owning the index is so concentrated right now, and it really puts folks in a really vulnerable position if that's where they are, because basically, as you said, Tom, they're owning 7 stocks, and we don't like to do that for our clients. So we select 40 to 50 stocks, depending on the style, depends on what their objectives are, and that's where you don't have to be exposed. Tesla's a good example. We really view that as a margin risk story. We agree that they're an auto company, not a tech company, and their margins are going to have to compress. That's an example of something potentially to avoid. And so you want to pick your places, and you want to be diversified. And while you might look back and say, well, I wish I had owned those 7 stocks, and that's all I wish I had owned, you may not feel that way for the next year or two. And all I have to do is remind people of what happened in 1999 and 2000.
Off a ratio analysis, where in the income statement, if you have 50 stocks and you got 7 chosen, my quick math is, Lisa, help me here, that's 43 stocks I got to go find. Where in the income statement, the cash flow statement, is the determinant of those 43 other stocks?
Well, those statements are a nice snapshot of what the company has just done. But what you actually want to do also is to look at what the company may do for the next few years. And so you have to go beyond the company's financial statements and look at what their end markets are doing. So if it's a tech company, you look at the shape of not just end markets these days, but also politics these days to factor that in. But, a starting point is that balance sheet. How secured are they in their cash position? Can they ride out a recession, for example? So that's, certainly one way to look at that snapshot. But more importantly is to look to the future and see what they can generate. Are they covering their dividend? Another reason to look at the cash flow statement, for example. So you want to look at the quality by looking at those snapshots, but then you want to look to the indicators of the future to see what the best thing is to hold going forward.
Joanne, can you translate some of these big picture, longer term concepts into the near term drama over the past 2 weeks where everything seems to have changed in the Middle East? How in the past 2 weeks have you shifted any of your views, if at all?
Yeah, so, the past 2 weeks, the rise of geopolitical risks that we've seen is something we have been talking about for a long time. It's been on our list, whether it's Europe and Ukraine, China and Taiwan. We've always mentioned the Middle East as a potential flashpoint. What has changed, though, is probably most directly for the U.S., a rise in our military budget. And I think that's one of the reasons, by the way, why we're seeing an increase in interest rates, is in recognition that the U.S. is going to be spending more, that the deficits are going to be sustained or grow, and that also, by the way, we have this dysfunctional government, which could put at risk the normal operations of raising the money to fund the military and other activities. So I think the biggest, most concrete implication of the last 2 weeks for the U.S. is the budgetary implications. And then obviously the risk of this spreading more broadly, creates risk to the normal economic order. So we have always owned defense industry companies, for example, in most of our strategies to provide some buffer against that kind of a risk. They tend to do well when these flashpoints kick in.
The reason why I ask that is because it seems like the world is moving very fast for us who have to cover it and give narrative to all of the movements every day. But most of the investors who we speak to seem to be sticking to broader, longer-term themes and not making quick allocation shifts on a dime. What would make you make a material allocation shift given the evolution of current events?
Well, I think if things really spread beyond the current conflict, for example, and there was an active war with Iran, right? Obviously, that would change the oil outlook. We might end up with more exposure to oil than we otherwise would. How would higher energy prices affect our other holdings, for example? Higher costs of doing business comes from higher energy prices. Right now, energy prices are fairly moderate. That could change the outlook. Also, a broader war could spread us into a longer period of adjustment.
Joanne, thank you so much. Joanne Feeney with us, Advisors Capital Management today, here with this bond market move that we're seeing. Lisa, I've been looking at some of the tried and true bond portfolios out there, and I've gotten a huge response from this morning. Thanks for the emails. This basic idea that everybody's looking out to the future, which I get, but when equity markets crater, we look at the crater, and we sort of say, like, okay, here's where we are, what are we going to do? And I see this huge ignorance of price down, yield up. I'm looking at a major famous fund. Doesn't matter what it is, 27%, full faith and credit, 20. It's spread out. It's a carefully balanced portfolio. You ready? 15 15% in cash because they're just waiting. Usually it's 4 or 5% cash. They're waiting to go in.
Or cash is just simply a better investment. They're yielding more than any other major fixed income asset class out there, at least so far this year.
We're going to follow this as much as we can, this bond debacle. It'll be a huge theme for us. And of course, Oliver Crook is in Israel as we continue to watch the Eastern Mediterranean. We will watch at 12 noon today our David Weston in conversation with the chairman of the Federal Reserve Board. Stay with us. This is Bloomberg.